generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We said we had to pass this legislation. We made a promise to the American people that we were going to deliver the real relief they needed, and now we have fulfilled that promise.
Senate Majority Leader Chuck Schumer over the weekend, a $1.9 trillion plan. Is it too big? They don't think so. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's the Monday morning price action. Futures down 23 and off by 0.6%. No break for Tesla bulls. Tesla down another 3.8% in early trading. In the bond market, yields are higher by 2-3 basis points to 159 on 10s. In the FX market, the dollar is stronger. Euro dollar 118.77. That's WTI on the screen, Tom. $66 a barrel. Briefly 70 on Brent earlier this morning.
Even through $71 a barrel, watching it closely. And, of course, with that event there, the politics of Saudi Arabia, this is a real flip from the Trump tone to what we see with President Biden. Of course, much of that can be said about everything in Washington. Emily Wilkins briefs us this morning, gets your week started on Washington politics, of course, with Bloomberg government. Emily, I know John and Lisa want to dive into the stimulus. I want you to discuss now Joseph Manchin, the third of West Virginia. We all observed his power. We knew it was coming. It was here. How powerful is Joe Manchin of West Virginia to get to voting rights legislation and to get onto the infrastructure tax bill everyone's looking for?
So we saw Senator Manchin's power this last weekend when a vote got held up for 12 hours as both Democrats and Republicans tried to sway Senator Manchin on their support for amendments. He did wind up eventually siding with the Democrats on that. And look, I mean, the big question with the Senate that we're looking at right now is this filibuster. The filibuster is a thing that doesn't let Democrats get their legislation through because it requires 60 votes. Democrats only have 50. And so their question, should we eliminate it? And yesterday you heard Manchin's tone on this issue soften a little bit. He says that he wants to protect the rights of the minority, that he realizes that Democrats will at some point in the future be in the minority. But you also saw him sort of be more open to getting things done. And there are some potential reforms out there that would not eliminate the filibuster, but might make it easier for Democrats to get some of their legislative priorities through, including the voting rights bill that you just mentioned, Tom.
Emily, we'll talk about what's next in just a moment. Talk to me about the changes made in the Senate to this bill and how the House will digest that in the coming day.
So the biggest one that we saw is around the supplemental unemployment benefits. The House passed a bill that would have them be $400 a week. The Senate bumped that down to $300 a week. And everyone immediately looked to House progressives and said, hey, guys, are you okay with this? And they said, we're not happy about it, but we're still going to vote for the bill. As we're seeing now, we're not seeing any sort of major opposition in the House. Remember, only about 5 or 6 lawmakers would have to decide, Democrat lawmakers would have to decide to vote against this bill to get it in trouble. But at this point, it seems like Democrats are pretty much united that even though this legislation might not be perfect, they believe that it will deliver the relief that the American people need.
Emily, you know how this works on Wall Street. Thank you. Next. What is next?
So next we see President Biden signing a couple executive orders today around gender equality. We saw him sign a couple executive orders previously about voting rights. But look, if you're looking for the next big thing, it's infrastructure and it's transportation. President Biden met last week with a bipartisan group of lawmakers on this. This is what people on the Hill and off the Hill are beginning to turn their attention to. Exactly what does a large infrastructure package look like? What does it include? And perhaps most importantly, how are lawmakers going to propose paying for this? Will it be some sort of tax increase? And if so, where would that come from?
Emily, we talk about International Women's Day and Biden signing some of these executive orders. Sometimes it feels like lip service. This time there is an imminent need, given the fact that 18% of the jobs held by women were lost in the United States between February and April versus only 14% of jobs held by men. There are still many more women out of the workforce. What is he proposing exactly to do about this? And what are people saying about how it will affect global growth or national growth anyway, if affected and implemented effectively?
So let's be honest about what President Biden's limitations are here. A lot of the executive orders are sort of in-house type things within the federal government. And sure, the federal government is a major employer. It employs hundreds of thousands of people, but it only has a certain extent of going so far. If we really want to see sort of big things being done for women, as far as child tax credits, maternity leave, other major policies, these are things that have bipartisan support in Congress. It is simply a matter of those getting enough of a priority to go through either as part of larger legislation or as standalone bills. So the interest is there, that we just haven't seen yet sort of a major push given some of the other items around that Congress is working on.
But Emily, to follow on from Lisa's important question, I'll cut to the chase. If we haven't learned about the child care crisis in this country, in this pandemic, we're never going to get it. What's the mood now of a bipartisan child care solution?
It's definitely out there. You're hearing proposals from Republicans, both in the House and the Senate, who want to move on this. I think if there is going to be a way that this goes forward, it might be something that winds up being attached to a larger bill or a larger package. But at this point, President Biden, he is signing these executive orders. He's bringing attention to it, but the president can only do so much.
Emily, good to catch up. Emily Wilkins there, Bloomberg Government down in Washington, D.C. These social justice issues matter so much more to financial markets now because they matter to the Fed, Tom. It's now a target, and we need to think about that a whole lot more. And I think in simple terms, what it means is a timing issue for policy. They won't just target the aggregate numbers now, they're targeting disparity. And to address that, they'll have to wait a whole lot longer than they otherwise would have before, which means a Fed on hold for maybe a long, long time.
I think, John, you just have to walk through Midtown Manhattan. I mean, across the zip codes of our viewers and listeners, it's real simple. Everybody has a different story, a different experience. Maybe I would suggest in this pandemic, you can't get these companies restarted and certainly in office restarted without some form of new effort on childcare.
Yep.
I'll be honest, I don't see it out there. Maybe I'm not briefed correctly.
Lisa, couldn't agree more.
Well, and there's a question about not only for the Fed, but for growth in general. I mean, productivity isn't great when you're dealing with kids who need to be fed, kids who are bored and haven't gone outside, kids who can't socialize, kids who need to be catered to in every which way. And stimulated at a time when they can't get outside. This has been a huge issue for all parents.
John, help us. How do they do it in the United Kingdom? Is it the same old, or is it better?
No, the entitlement system clearly in Europe is a whole lot better, Tom. And the United States has got a whole lot more work to do on that front. I would just say, look at the Friday jobs report. Female participation up, I believe. Black unemployment higher. That's a huge problem. So when we talk about a blowout jobs report on Friday, for who is the question the Fed will now be asking. And this is not just about being some social justice warrior. Follow what the Fed is doing, what they're telling you. Whatever you believe in, look at what the Fed is doing. The Fed is not targeting the aggregate numbers anymore. They're targeting disparity, and that has big consequences for the conversations we have about financial markets day to day, week to week.
And John, this is the reason why people are getting concerned about inflation running hotter than perhaps people had previously expected, because if the Fed is targeting these issues, they might happen. The quality that they're looking for might happen after the economy has run much hotter than we're used to.
But we're not going to get inflation, Lisa, off a sound, sensible child care policy
I would agree.
Across a broad part of American society.
I would agree.
And no one's going to disagree with that, Tom. Coming up, Liz Economy, Senior Fellow at Stanford University's Hoover Institution from New York City this morning. Good morning to you all. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market down 20. We recover just a little bit. We're off 0.5%. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Today on Bloomberg, a conversation with ARK Investment CEO, CIO, and founder Cathie Wood. 5 p.m. Wall Street time on Bloomberg Television.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg Television. Here's the price action to kick things off this Monday morning. We're off session lows. We're still lower by 0.7% on the S&P 500. On the Nasdaq, off by 1.66%. The story, the headline, really. Good news is bad news for big tech. Let me show you what I mean by that. Switch up the board and get to the pre-market price action. When growth is scarce, you'll pay up for growth. When you throw a $1.9 trillion plan on top of an economy that's reopening, growth in the minds of a lot of people will no longer be scarce. Here's the pre-market. Apple down by 1.8%, Amazon off by 1.2%, Tesla off by 3.8%. Amazon over the last month is down almost 10 percentage points. And these three names alone, almost a quarter of the NASDAQ 100. And that right there is your problem in this equity market. Let's finish on this. 2s, 10s, 30s, into the bond market we go. Yields higher. That's kicking around big tech too. Your 10-year just south of 160. We saw 162, Tom, on Friday, just north of that. We started to get used to a little bit, get used to life north of 160. This morning, just south of it. Your 30-year settling down at around about 230. But right now, Tom, the Fed seems okay with this. Bank of America, though, saying if this starts to test credit and financial conditions, which they're starting to think it will, that's when the Fed comes back in a different way to what we saw in the last couple of weeks.
Well, we'll see off the quiet period here to March 17th, which I believe is the next Fed meeting. Look for our Fed coverage then. This is a joy on International Women's Day because International Women's Day is about courage. You need to have courage to write a thesis, write a book when you're very young that defines China. That's what Elizabeth Economy did out of Swarthmore on her way to a Michigan PhD. That book was The River Runs Black. The new book is the book I would reread on China. I read The Third Revolution cover to cover. It is absolutely definitive about the new China. We are thrilled Elizabeth Economy could join us today with Stanford University's Hoover Institution. Dr. Economy, thank you so much for joining us. I need to go back to your claim of The River Runs Black. How polluted still is China?
China is still facing an environmental crisis across many fronts. It's made a lot of improvements in terms of its air quality, particularly in the wealthier coastal areas. But you still can't turn a tap on in China and get clean water throughout most of the country. They haven't begun to tackle really extraordinary levels of soil pollution. And, we've seen now that China's contributions to global climate change have continued to increase every year over the past 4 or 5 years. despite pledges to lead, in the fight against climate change. So definitely made some significant improvements, but there's still a long way to go.
Let's get out front of your next book, The World According to China. I believe we'll see that end of this year. You'll look for the movie, folks, in 2025. And Dr. Economy, what I want to talk about is moving on from the third revolution to what you have learned about President Xi and the federalism of Beijing in the last 12 months.
Yeah, I mean, look, I think what's been surprising and fascinating both about Xi Jinping is the extent now to which China believes that its governance model is as good, if not better, than the United States and other liberal democracies. I think coming out of the pandemic, Xi Jinping, with Chinese leadership, they believe that the wind is at their back. Right, they grew at 2.3% last year. Clearly, we did not, nor did any of the other major economies in the world. And so I think we now have, not only an economic competition, a technological competition, even a strategic one, but also a values competition. And for me, looking out at China now, I think that's one of the major challenges that we're going to confront.
One of the issues, Elizabeth, that the Nationalist People Congress has talked about is getting better tech dominance in China, particularly with semiconductors and manufacturing chips. How do you expect that push to change the equation in the years ahead, given that so much of that really comes, at least from the intellectual property side, from the U.S. right now?
Right. I mean, I think it's important when we're looking at this technological push to recognize that this push has been going on since the 1980s and has only accelerated, under Xi Jinping. So looking at the Made in China 2025 program that came out in 2015, that was really about, China in many respects decoupling from the United States and other technological leaders globally and saying, we want to control manufacturing in 10 critical cutting-edge areas of technology, right? Control the manufacturing of components. And now we have Xi Jinping's, dual circulation theory, right? Which basically says we can innovate, we can manufacture, and we can consume, at home. And the semiconductor issue has become kind of the cutting-edge issue for the Chinese because of the trade war and because of the restrictions that we've placed on semiconductors for many of many of China's sort of leading companies like Huawei. And so they have pushed forward, I think, very aggressively with huge levels of investment. And so you have scores of new companies emerging, that are devoted, right, to semiconductor design or manufacturing. But the truth is that most of these are falling well short of their ambitions. You have seafood companies that are starting, a semiconductor part. You have a lot of bankruptcies that we're seeing right now in the semiconductor sector in China. That's not to say that they're not going to succeed, that they're not going to make progress along the way. But I think it's important to recognize that when we hear about these big pushes and these big, targets that China sets out, that there's an enormous amount of waste and inefficiency that goes along with those efforts.
Well, Elizabeth, the issue here that I see is it also puts tech and national security increasingly hand in hand. And we've seen this again and again, whether it comes to what Joe Biden has talked about or what China has talked about, what Xi Jinping has talked about. And now we have this sophisticated attack of Microsoft's business email software. And there's a question of the retaliatory moves that could ramp up, which we've already seen. How could we see this tech war and the national security issue escalate when it comes to either tariffs or other measures that people should be looking out for?
Well, I think one of the things we've seen out of the Biden administration is that they're taking their time in trying to understand the lay of the land with regard to that relationship that you've just sort of pointed to between tech and national security. And the Trump administration, took a very sort of sweeping approach, to the point that almost anything that we did could be seen to help China and to help Chinese economy. And so that sort of that group of technologies just kept getting bigger and bigger, right? And where we thought we would have to draw the line just became more and more blurry. And so I think the Biden administration is trying to figure out, how to ring fence technologies. How do we say these are the core technologies, for our national security that we need to protect? As far as the cyber attack is concerned against Microsoft, look, I think you don't need to think about that as retaliatory. China has continued to launch, cyber attacks against the United States. There's been no let up in cyber attacks. This was a big one. It was significant, but it's not as though companies aren't facing, thousands of attacks from China on a daily basis. So I think we shouldn't, think that this is somehow new or this is somehow in response to something the United States has done in particular. This is an ongoing challenge.
Liz, can this administration in America get Europe to come along with them?
So this is one of the great issues. I think, look, the Biden administration came in and said, we're going to do things differently in a couple of significant ways from the Trump administration when it comes to China. And one of them was to, or is to, work more closely with our allies. You know, Asian allies are 99% on board with the direction in which the United States is moving. You know, Europe, France, and Germany in particular have, you know, talked more about, Macron certainly talked more about strategic autonomy, you know, wanting to set the EU on its own course. I think when we look at the nuts and bolts of the areas of cooperation, we're going to see more cooperation rather than less. And I think that's true on the human rights front, where we have seen that kind of cooperation over the past few years. I think it's true on the security front, where we now see countries like Germany, the Netherlands, France, the UK, all sailing through the South China Sea in support of freedom of navigation, you know, along with the United States and Japan and Australia. I think the big issue is the trade issue. And I will say, the other thing to consider is that, you know, Europe is more than just Germany and France. The UK has been surprisingly strong when it comes to China and Hong Kong in particular. And other small countries are also pulling away from China. So I think it's going to be interesting to watch as Europe disaggregates a little bit. There may be other opportunities for U.S. cooperation with European partners.
Liz, one final question, and it's not out of the realm of thought that James Dimon or Brian Moynihan would call Dr. Economy to get your view. Elizabeth Economy, how should the American banks respond to the limitation of liberty in Hong Kong? What should they do in Hong Kong, Shanghai, and Beijing?
You know, I think the Trump administration, you know, started by sanctioning Hong Kong officials, you know, my concern is that I don't want to harm the Hong Kong people. Look, the Chinese government is basically, you know, at the same time starving and suffocating democracy in the country. You know, I don't want to see a massive pullout of our companies and our banks. But I want us to open our doors to the Hong Kong people. You know, I don't have any silver bullet for this one. You know, I think we're going to treat Hong Kong the way that we treat the rest of China. Because that's increasingly what Hong Kong is going to be. It's going to be just another Chinese city. So it's a tragedy, actually.
Liz, it's good to catch up. Elizabeth Economy there of Stanford University's Hoover Institution. Tom Keene, just another city. That's not what people had in mind a couple of decades ago.
Shocking. You know, for me, it's a distance in China. You know, I tell you, John, I kid about it. I go deep into China, which is the airport, the Mercedes, the Mandarin, then I turn around and go back again. So I'm no authority on this. But those words that she just said are absolutely stunning. Yeah. And it goes back to what, you know, the conversations we've had in the United Kingdom as well.
Well, the broader conversation here is the US confronting China, not calling it confrontation, but competing with China, Lisa, and whether they can get the Europeans to come along with them. And most people would argue that maybe this has gone too far, integration is too deep, and the Europeans are going to be reluctant to do things on the economic front. In the United States, we've seen example after example of American international, multinational companies. That's where they want to be. Regardless of what was coming out of the administration, that was where they wanted to be.
And that's the real challenge. I mean, perhaps Europe naturally has an alliance with the United States on this front. The question is, do businesses that want to grow as fast as they can?
Coming up, Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine, on an improving pandemic and just a phenomenal vaccine rollout in the last couple of months. More on that still to come. Futures down 23. We're off by 0.6%. Yields just south of 160 on 10s, 159. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senate Democrats made some changes to President Biden's stimulus bill, mostly to appease moderates and comply with parliamentary rules. But those changes aren't likely to keep the measure from sailing through the House tomorrow. It's still expected to be a tight vote. House Speaker Nancy Pelosi can afford to have only 4 Democrats oppose the bill and have it pass. And President Biden will formally create a gender policy council within the White House. It's part of 2 executive orders he intends to today to mark International Women's Day. He'll also ask the Education Department to re-examine the Trump administration's policies and rulemaking on Title IX. That's all which governs the way sex-based discrimination in schools is handled. And Bloomberg's learned that General Electric is close to an agreement to combine its jet leasing business with Ireland's AerCap Holdings. A deal would join the world's two largest aircraft financiers. The two businesses have almost 3,000 aircraft owned, managed, or on order. A combination would speed up GE's push to further shrink the company. An attack on Microsoft's business email software has turned into a global cybersecurity crisis. Hackers are racing to infect as many victims as possible before companies can secure their computer systems. Microsoft says the attack started with a Chinese government-backed hacking group. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I do think that we're ready. I think people want to go back. I think they feel it. They feel the need for it. And you ask about the risk. I think the risk is actually in not going back to school tomorrow, given all the suffering, all the loss of learning we have seen.
British kids head back to school, one of those rare occasions where I'm sure many are actually helpful and grateful that we're going back to school in the UK. And that's the kids, not just the parents. Boris Johnson, the Prime Minister in the UK, alongside Lisa Bramwitz, Tom Keane, I'm Jonathan Ferro. Here's the price action this Monday morning. Shaping up as follows on the S&P 500. Down 22, we're negative 0.6%. Yields higher through much of this morning. A breach of 160 earlier, 158.72 is where we are. Nasdaq futures, where the epicenter of the pain has been. As we reopen these economies, the UK sending the kids back to school. Tom Keane, in the United States, 2.16 million doses per day. That's your daily average now over the previous 7 days, and more than 9% of this country fully vaccinated.
And John, we're each living it by our experiences. I enjoyed immensely on Friday the stunning execution of lining up people within the sanctuary of a building to get vaccinated. It was New York Presbyterian and the Armory up on 169th Street. I was shocked how they nailed it. Lauren Sauer knows this. It is so important how we deliver these vaccines. She is with Johns Hopkins and their associate professor of emergency medicine. Lauren, I don't know what the number is. 60% want to be vaccinated. Maybe I saw a better statistic, 68, 69%. What's the number one way to get that percentage up?
I think we have to get more vaccine into arms so that people see that this is a safe and effective vaccine. That's probably the number one thing. And then number two is to build better access points. So as people see that they can access the vaccine easier, they're probably more likely to want it as well. So we have to build that trust that we've been talking about all along, but we also have to make sure that as the trust is being built, we give people the path to access the vaccine.
Are we going to see companies actually distributing the vaccine themselves, given the fact that that might be or has been proposed as one of the most effective ways to distribute the inoculations?
I think as we move out of this emergency phase and into the sort of broader phase of vaccinating the entire population, not just our most vulnerable or most critical people like healthcare workers, for example, we will explore so many new options for how we distribute vaccines. So if we see that something's not working, we can move on to, if a max vaccination site is not really getting people through in a way that's safe and effective, then we look at other strategies like going with companies. We can also look to getting vaccines to local healthcare providers, trusted community healthcare spots, all different, community access points should be explored.
Lauren, when do you think the free-for-all, so to speak, begins, given the rate we're at right now?
I think in the next few months, we're going to start to see a situation where as vaccine supply increases, we get to the point where people can really start to access it. Anyone who wants it can start to access it. I think the concern right now for a lot of people in vaccine distribution is that we'll get to a point where the people who are having a hard time accessing it continue to have that hard time and eventually give up. So we want to make sure that as we're building that trust in the community, that we're also expanding the access points to be as equitable as possible.
These are brilliant numbers, 2.16 million. We were at 900K when President Biden took the White House, and we've accelerated since then. I just wonder whether we need additional vaccines in this country, Lauren, and how we should distribute individual vaccines at the moment. We have J&J, Moderna, Pfizer, and we're north of 2 million, and the supply chain looks good. How do you think about that challenge at the moment, whether to take on AstraZeneca as well and others too?
Yeah, I think the more vaccines we can get into utilization, the better. Globally, we want to see broad spread of the different vaccine types. The supply chain for some of them can make that challenging, but at the same time, we don't want to be in a situation where we're only distributing one in one location and a different one in another. We want that coverage. There's different benefits to the different types of vaccines. Different populations may desire certain vaccines. So anything we can do to broadly expand the coverage with different types of vaccine, better.
Lauren, I look at all the years we have of Farm Aid and other We Are the World, all the different charitable things, and it's all celebrity driven in America. We all know that. I have been absolutely thunderstruck that, for example, Pfizer doesn't go out and get 20 different celebrities, Tom Brady, Beyonce, John Farrow, and the others, and just line up 20 celebrities to say, look, it's not going to kill you. Have you been surprised that we haven't done that?
I think that this was talked about early. I think we'll start to see that as vaccine becomes more readily available. In the first, in the first amount of time that we've been trying to distribute right now, where we're really targeting those most vulnerable populations and the highest risk groups, it's really been important that every vaccine goes into the arm of someone who needs it so desperately, right? So any vaccine that goes to a celebrity is a vaccine that doesn't go into a healthcare worker or an elderly individual. And for right now, I am totally comfortable with that strategy. I completely understand, and I think that ultimately that is exactly what we'll see. We need community members, we need trusted celebrities, we need vocal people who are willing to show that these vaccines, when they go into people's arms, are safe and effective, and sort of live their lives in the spotlight so people can actually see that. But I think there's no pathway to give people those vaccines that doesn't create inequity for right now. So I have a feeling that will be the wave of the future, but I think for right now, it's right that we haven't seen that.
And by the way, Tom Keene was trying to throw it off to John Farrow that he was going to be the celebrity poster child. However, Tom Keene is quietly submitting his own name for that role. There is a question. Tony Fauci said over the weekend that he wouldn't face the nation, that he was looking to health officials to release guidelines on post-vaccination behavior imminently. The idea, can you go out? Do you have a free-for-all? And can you live life again? What do you expect those guidelines to be?
I expect that those guidelines will be sort of focused around the next safe step, right? So can you see your grandparents? Can you expand your bubble a bit to other people who've been vaccinated? Can you safely eat in a restaurant? And just like increasing your sort of zone of comfort. I think I do hear that they're eminent. I think we need them desperately, because when people have guidance, they tend to follow that guidance. But when there's no guidance, it's like everyone is making those decisions individually. And that's what we don't want to see. We want to see a clear path to reopening, almost like a roadmap that people can follow. And when you have the map, it's certainly easier to follow it. And when you don't have the map, you know, it's way easier to get lost. And right now, as cases are sort of plateauing, we don't want lost people wandering around.
Lauren, always appreciate your insight. It's valuable. Thank you. Lauren Sauer of Johns Hopkins, thank you very much. Aside from the fact that I thought half this country hated Tom Brady, Tom, I think the story here is the sequencing. It's the sequencing of how this is distributed, and we aren't yet at the free-for-all. And as Lauren pointed out, it's going to be a couple of months before we start that wider distribution effort, and that's when acceptance becomes a much bigger issue.
Yeah, and I thought she was really eloquent there, John, on how far we've come, how fast. You've been great about talking about the buildup in vaccines, and I guess my impatience here is right. We just got to wait a couple more weeks to let this unfold.
A couple more months, maybe, Lisa.
Weeks.
Well, I hope that it's sooner than that. I think everyone's really impatient people. Tony Fauci even saying, just a couple weeks, guys, hold on. Stop with throwing away the masks. Put them back on. We're not out of the woods.
Texas reopening, and I think Tom asked the important question last week. Who's next? From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Up next, conversation you do not want to miss on this equity market. Abby Joseph Cohen, Goldman Sachs Senior Investment Strategist. Your equity market down 21, negative 0.5%. This is Bloomberg Surveillance.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Keep rising until we get that disorderly market functioning.
It's going to be very hard for yields just to sit there and for the market to believe that the Fed isn't going to move sooner.
If the Fed starts talking about tapering their asset purchase program, I think that'll be negative for risk assets.
The market is looking for any positive data in order to continue to justify this march higher.
Half of the market wants to have better job data, and the other half of the market is scared of that because of the potential inflationary consequences.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market taking a dive on the NASDAQ, off by 178, call it 180, down 1.5%. Tom Keene, it's been a struggle. The outlook gets better, the data gets better. That's bad news for big tech.
Well, it's a struggle, but it's a churn and it's gotten better. The tape's marginally better over the last 90 minutes. John, the VIX tells me a lot at 27. You know, we're not out at the 30, 31 level, so I'm not sure how rustled up I am this morning.
160 on 10s, Lisa. The data's better, the outlook's better. Throw on top a $1.9 trillion plan out of DC.
Yeah, although this is not necessarily stemming as much from inflation as it is real yields. And you've been making that point again and again, and we're seeing it again today. Real yields rising, still negative, and deeply so. But really, there is a question how much the Fed will cap any yield rises as people give a better outlook to the global growth look.
Well, here's the story right now. Looking at the bond market, I said 162. That was the high of Friday's session. We took a little sneak peek of north of 160 this morning. Here's the price action at the moment in the equity market on the S&P 500, down 21 on the S&P. We're negative 0.6% in the bond market, 159.07. Yields up by a couple of basis points. And in foreign exchange, dollar strength, euro with a 118 handle. What happened to the calls for 125? What happens to the calls for 130? That dollar's made a comeback, Lisa. Euro dollar comes in 0.4%.
And how exactly does this play into the global reflation story when you talk about how much that was underpinned by a weaker dollar feeding into the developing world? This is another thing that we'll explore throughout the hour. Today, 10 a.m., I'm really interested to hear what Janet Yellen has to say, Treasury Secretary at the IMF. She's going to be speaking with Kristalina Georgieva, the IMF Managing Director. It's for International Women's Day, and it comes at a time of growing disparities within the labor force. Interesting to see how the former head of the Federal Reserve has moved over to a policy role and made a concerted effort to try to narrow some of these gaps. Now, the Fed is putting increasing priority on, John, just as you were talking about. Today, we're also going to be getting some gender equality policy measures, executive orders signed by President Biden. Unclear how much clout these particular measures will have, but they could potentially underpin some of what, Tom, you were talking about earlier when it comes to child care credits, as well as just early childhood provisions, given the fact that so many women stay home because they don't have a lot of other options. And also today, the House will be laying out the guidelines for voting tomorrow, most likely, on this $1.9 trillion stimulus. John, you've been talking about that $1,400 check per person. Very needed, very important to get the economy going again, but also how much will go straight into the meme stocks?
Yep.
How much will go straight into specific equities in markets that have already been bolstered by these types of checks in the past?
Let's talk about one of those right now, GameStop. GameStop up in the pre-market by 11.5%.
What do we make of this?
Well, Tom, what I think we forget is that there is actually a fundamental story to this amid all the craziness over the last month or so. And that guy's name is Ryan Cohen, who's a board member of GameStop. Also, of course, the founder of Chewy.
Really?
And they're tapping him to lead the e-commerce shift. And that's what many people wanted to see. And I think what's going to be interesting here is how they find the capital to fund that shift to e-commerce in a more aggressive way, Tom, and whether there is a capital raise at some point down the road, given the buoyancy we've seen in this name on and off and on over the last couple of months.
I'm glad you bring this up, and within the context of what we do on this simulcast, I don't know how it fits in, but I would say, John, to see what small caps have done, and particularly, as Lori Calvasina has said, the broad swath of small caps, including the sexy stuff like this, if you're just in value, it's difficult.
Well, you've got small caps, Tom, and then you've got the craziness. And GameStop has been part of the crazy story. The small caps is just a pure cyclical trade on a better America, a better outlook, higher yields, and that's really delivered year to date so far.
Yeah, I want to go back to Liz economy quickly here. Renminbi here at 6.53. John, Pacific Rim having a tough time of it.
Tough time. Why, Tom? Dollars up. Why? Treasury yields are up. Why? The outlook's better. Why? Because we've just thrown $1.9 trillion on top of the outlook as we reopen this economy. Tom, the grand experiment is here. It's playing out before our eyes, and we'll start to see the data that backs up a better outlook in the coming weeks and months.
The grand experiment, John, at Goldman Sachs many, many years ago was to say, Abby Joseph Cohen, we can hire her and she can make a name of it. On Women's International Women's Day, it's very important that we speak and get the current thoughts of Abby Joseph Cohen of Goldman Sachs Advisory Director and their senior investment strategist. Abby, you have seen this too many times before, the angst of the ambiguity, up we go, almost the fear of economic and GDP success. How do equities react when you get a surge in GDP as we anticipate?
Well, Tom, first of all, thank you very much for including me today in the discussion. It is an important day and an important week for women. You are asking exactly the right question about the markets, and that is this. Is it good news or bad news for the economy to be recovering? And I would say it is good news. Now, we are seeing, of course, this very significant rotation in terms of views. Those stocks that have performed extremely well only because interest rates were down and low may have a problem, but there are plenty of other opportunities in the equity market as we do see a rotation towards those stocks that do better when we feel more comfortable with the pace of economic recovery and hopefully over the next couple of years, true economic expansion. These, of course, include the small cap names, also the value names where there's been this wide gap in things like PE ratios and so on. We're also seeing an improvement in stocks that are rate sensitive. There are some securities, some companies that do better when interest rates are a little bit higher. And we, of course, are seeing some movement now in those sectors that do better when we come out of lockdown. And the good news on the vaccine will, I think, be helpful. And, of course, those areas include things like restaurants and accommodations.
Abby, I'm not going to mince words. Goldman Sachs has been out front on a bull call. Costin has led the way to SPX 4300. What does the gloom crew get wrong?
Well, the argument behind this really great outlook from David is also based upon the above consensus view from Jan Hatzius, our chief economist, who believes that this year the U.S. will see GDP of close to 7%, and it's even better fourth quarter over fourth quarter, basically about 7.7%. And that's based upon, let's say, four factors. Number one, this very robust fiscal package. Number two, the Fed staying basically friendly. Number three, the virus-depressed sectors beginning to rebound. And also, let's remember that there's an awful lot of pent-up savings in the economy. The average consumer balance sheet, and again, I'm looking at the median, there are many exceptions, but the average is actually looking good. Debt balances are down, savings are up, and when people feel a little bit better about the outlook, they'll start to move forward and start spending, and that's great for the economy. But you asked about the gloom crowd, and I think what the gloom crowd keeps coming back to is that there could be an uptick in inflation. wouldn't be surprising. That's built into Jan's forecast as well. But let's look at inflation as being a function of two different things. Number one, there are some special factors happening this year. Maybe it's the energy prices and so on. And there's also, of course, that quick rebound in prices from the very depressed levels that we saw in some sectors in 2020. But the second important reason that inflation may move up a little bit is that we are seeing an improved economy, and I think that's great news. You know, it's the opposite side of the coin. On one side, the economy is doing better. On the other side, prices are not quite so depressed. The Goldman Sachs forecast on CPI does show it moving up from about a 1.1 last year to 2.5 this year. But in 2022, we're looking at CPI of about 2%. By historical levels, that is not a problematic level for inflation. And by the way, that is the Fed's target level for inflation, about 2%.
Abby, you've seen it all, and many people come on this program and they try and look to history to find a parallel with the moment we're in right now. How original is this moment, and what makes it unique?
That's a great question, and I think what makes it unique is that none of us, regardless of how long we've been in the markets, have seen a pandemic-inspired recession, bear market, and now, of course, the recovery. And what pleases us in terms of what might happen is that we are seeing policies that are aimed at providing relief. So we've had a friendly Federal Reserve, and other central banks are doing what they can as well. And now, of course, we have this very meaningful relief package coming in the form of fiscal policy. And I think it's important not to categorize this totally as a stimulus package, because it's not. It's a relief package aimed at getting us out of the hole. And the next important thing to be watching is what the Congress can pass and the president can sign with regard to really moving us forward. And that would include things like the infrastructure reform, things like addressing some of the big issues in the labor markets, and there are some underlying problems that really must be addressed and are not quite addressed yet, even in this very large package that we expect to be signed into law later this week.
Abby, that's on the fundamental side, or it's become the fundamentals in terms of fiscal support. There's also a question on the technical side, what that means in markets. We've seen coming into this year is different also because the global reflation trade has not come along with a weaker dollar. In fact, the dollar is stronger against every single emerging markets currency, major one, out there year to date. And we're looking today at the biggest sell-off in the MSCI Emerging Market Currency Index versus the dollar going back to last March. How does that alter your views going forward? Or do you think that this is the indication of a different regime where the dollar can strengthen, yields can rise, and that doesn't come along with the rest of the world improving at the same pace?
Yeah. So let's step back for just a moment. When we do currency forecasts, obviously we're looking at all the same factors that other people are. But one factor really has dominated since the beginning of the pandemic, and that is the safe haven nature of the U.S. dollar as the world's reserve currency. And if anything, that has been somewhat enhanced over the recent past, in part because the United States has been able to take somewhat more aggressive measures than other nations in coming out. And we also are now looking a little bit better in terms of vaccination rate and so on. What happens going forward in 2021 will be a function not just of us, but is true of all currencies. What happens to other nations? So far, we have seen some disappointment with regard to some of the emerging economies. But one thing we should all be watching is whether an improved tone in U.S. economic activity will help bring our trade partners along with us. And that certainly would be a good news scenario.
I know, John, you mentioned that last week. Yeah, I mean, one final question, if we can, on this day, as we look to women like you that were out front. You know this, and I know this from the CFA Institute, that securities research led the way, whether it was Abby Joseph Cohen, Louise Giumata, what Sally Krawcheck did at Bernstein, and the wonderful Alice Beebe Longley, who I read religiously years ago, I believe, at DLJ. How do we impart what securities research did with women over to other parts of the financial industry?
Tom, it's a vexing question. What we basically see in financial services and some other industries as well, is that there may be a large number of women coming in at the bottom end of that pyramid, and we all have to do better, not just in financial services, but other industries, in enhancing that pipeline. So, for example, we do see that women are well represented in a number of industries, but as you move up, say, to the VP level or the MD level, that's where we see a flattening out. And by the way, while we can point to problems here in the U.S., it's worse in most other countries. And so they're looking to us, interestingly, to get things better. But let me spend just one more moment. You know, we tend to think about these professional white-collar jobs. The real problem for many women in 2020, this has not been a good year for women who are really on the front line, those who are heavily represented in some of those virus-afflicted sectors, including restaurants and accommodation, but also in state and local governments, where women tend to be overrepresented by numbers in positions like teachers and social workers. And over the last year, state and local governments have, in fact, reduced jobs by something like 900,000, and that affects women much more dramatically. The labor force rate for women now is much lower than for men. If you look at adults, it's about 70% participation for men. It's only 57% for women. And this has long-term consequences in terms of potential scarring of the labor force, especially for women.
Abby, really important issues, and we appreciate your time coming on this program this morning to share them. Abby Joseph Cohen there of Goldman Sachs. From New York City this morning, good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Democratic lawmakers predict that President Biden's $1.9 trillion stimulus bill will sail through the House tomorrow. The Senate made changes to the bill to appease moderates and comply with parliamentary rules. But those changes are unlikely to prove enough to make progressive Democrats vote against the measure. Goldman Sachs predicts the U.S. is on track for an employment boom this year. Chief economist Jan Hatzius says that reopening the economy, fiscal stimulus, and pent-up savings should fuel very strong demand growth. Hatzius and his colleagues say the jobless rate will fall from the current 6.2% to 4.1% by the end of the year. And Bloomberg's learned that GameStop is tapping the founder of Chewy.com to guide the company's transition to an e-commerce business. Ryan Cohen already is a board member at the video game retailer. He will chair a new board committee that will be in charge of GameStop's transformation. Elon Musk is getting into the Texas power market. He's building a gigantic battery connected to an ailing electric grid outside of Houston that nearly collapsed last month. The move marks Tesla's first major foray into the epicenter of the U.S. energy economy. And Prince Harry and Meghan Markle gave their side of the rift that's developed in Britain's royal family. In a wide-ranging interview with Oprah Winfrey, they described palace discussions about the color of their son's skin, losing royal protection, and the pressures that led the Duchess of Sussex to contemplate suicide. Harry said he felt trapped by the royal life and was surprised he was cut off financially. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It obviously wasn't easy. It wasn't always pretty, but it was so desperately needed, urgently needed. Everything in this package is designed to relieve the suffering and to meet the most urgent needs of the nation and put us in a better position to prevail.
The President of the United States there, Joe Biden, from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravis, I'm Jonathan Ferro. Your market shaping up as follows in the United States and worldwide. In the equity market, the S&P 500 coming a little bit lower, down 20 and off by 0.5%. The NASDAQ is where the pain is once again, with yields rising 2-3 basis points on 10s, getting back close to 160. In the FX market, dollar strength through G10, euro dollar 118.65, and to EM, to the more widely traded liquid names. The South African rand weaker by 1%, the peso down 1%, the Turkish lira, Tom, down 2%.
You know, the Turkish lira I'm watching, and the EM story I think is there, John, and valid. John, what I do see is yen 108.63, and if you get a euro equivalent of a 108.63, that's a changed landscape for Europe and for Madame Lagarde.
Couldn't agree more, Tom, and that meeting takes place on Thursday, that news conference with Madame Lagarde, the president of the ECB.
It's fluid.
I would say look back to the speech from Fabio Panetta of the last week or so, the recent speech from the ECB board, Tom, talking about the unwarranted tightening of financial conditions we've seen, largely off the back of a better America and higher Treasury yields. They don't see a better Europe right now, and that's the problem.
That's where I was going to go this weekend. Just shocking to see some of the challenges on the pandemic in Europe. Right now, after an exhausting weekend, Kevin Cirilli, our Bloomberg Chief Washington correspondent, with us. Kevin, I really want to move forward right now. Give us the timeline of the implementation of this $1.9 trillion. When is it dropped upon Americans?
So tonight, the House of Representatives is likely going to hold a procedural vote this evening, New York time. A procedural vote in the House of Representatives, a very narrow majority because of the Democratic advantage in the House of Representatives. So it's very narrow majority, and Speaker Pelosi has to keep her caucus together. And then as early as tomorrow, the House, after the procedural vote this evening, will then vote for final passage because of the changes that the Senate made to the piece of legislation over the weekend. So the biggest unknown right now and the biggest difference right now is that the House passed this bill with the minimum wage in it. The Senate removed that, as we've covered, and now the question is whether or not Speaker Pelosi can keep progressives on board without the minimum wage provisions in the Senate version of the bill.
Kevin, it's amazing. It's a $1.9 trillion bill, but the piece of it that gets the most attention, it seems to be the $1,400 checks. Can you run me through who's eligible now? Because there has been some changes over the last couple of months to that. And when they actually hit bank accounts,
they would hit bank accounts as early as almost immediately over the next week and a half to 2 weeks, because you have to remember that the government already has this system that is set up in terms of depositing those checks. There are various thresholds in terms of who would qualify for the $1,400 stimulus checks that, quite honestly, centrists were able to win in the sense that some of the provisions for those who get them. And so the immediacy and the qualifications was definitely a sticking point over the weekend.
Do you sense, Kevin, a permanent shift down in Washington? That this isn't just a pandemic story, that the kind of things that we've started to do in the last 12 months could stay with us beyond the crisis?
Yes, but I think that there's a clear marker in terms of where progressives are headed, like Senator Elizabeth Warren, who has advocated for increasing taxes as a source of revenue for some more broader form government programs like infrastructure, like universal pre-K, and versus what Republicans are laying down a marker for, like Senator Bill Hagerty, a former private equity official turned ambassador to Japan, who have said that the United States needs to do more to attract foreign investment in order to fund some of these programs. He's a Republican from Tennessee. And so that's really the dueling ideological lines that have formed over the last couple of weeks. Attracting foreign investment away from China versus raising taxes on the wealthy.
I can't let you go, Kevin, today without talking about Andrew Cuomo and what we've seen over the weekend with increasing allegations.
Why? Because they're going to be talking about Meghan and Harry, because that was the dominant story last night. But go ahead.
That was a dominant story, but in politics, that probably also was a dominant story. However, I'm still going to lead with the New York Governor, Andrew Cuomo, despite your penchant to speak about royalty and the fallen there. There is a question going forward of how much this will weaken Governor Cuomo's powers at a pivotal time of distribution of the inoculations at a time when we need leadership, and he had the leadership, and now it has been stripped.
This is a very serious story. And the Democrats that I talk with, who at one point defended Governor Cuomo, aren't there anymore. There are two serious stories we should mention: the allegations, as well as the alleged cover-up with regards to the nursing home data. I'm hard-pressed to find too many more Democrats up on Capitol Hill who are standing by him, but he has been adamant that he is going to continue to stay in that position and that he is not going to resign. He is very isolated from the Democratic Party.
Kevin, good to catch up, as always. Looking forward to the coverage on that particular story as well. Kevin Cerruti, Chief Washington Correspondent and host of Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern. Here's the quote from Senator Schumer, the Majority Leader. Unity, 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 that's how we got this done. On every single important vote, every Democrat stuck together. Now, Tom, this was a partisan bill, and I know many people assumed it was always going to be that way, but that's not how the president started things off. It was a bipartisan effort. He had a group of Republican senators into the White House to have a conversation about what should be in this bill. Those negotiations seemingly, Tom, went nowhere, and I just wonder what the next huge bill, the next huge effort looks like on that front.
There are two next bills. One's on voting rights and the other's on infrastructure / taxes as well. But, John, this is a Joe Biden from the 70s, which is the way you did things back then. And, you know, all I can say is if he hadn't done that, there would have just simply been a greater tension.
Tom, no one disagrees with you on that front. But the point that's been made is whether this effort sucks the life, the oxygen out of the next effort. Can they do this again on infrastructure? Do they need people to come with them?
Yeah, we'll have to see. On reconciliation, they need 50%, not the filibuster issue. And, you know, they've got to do it because by the time they get to this, John, critically, we're going to be into some serious primary season for November of 2022.
And we're going to have some seriously good economic data.
Yes, well said, well said.
That's the issue, Lisa. The economy will reopen. I call it an issue. It's an issue if you want to spend another $2 trillion. When the economy reopens and the data starts to look better, you know what comes back into the conversation. Do we need this? Can we wait?
Yeah, although Joe Biden has the support, the popular support. If you take a look at all of the polls, they show that people are very much behind this. And, John, you can say this has to do with the fact that they're getting $1,400 checks. Certainly, money helps. At the same time, if there is material growth, perhaps that support will build, and then constituents don't have to change their minds. John, I think it's fascinating to think that Joe Biden's challenge is to convince people that government can work, that smaller government necessarily isn't better, that perhaps more government support will actually foster growth. That is his challenge.
That's not even a challenge at this point, given what we've seen over the last 12 months, is it?
Well, longer term,
passed?
That's the question.
A $2 trillion plus bill, another $1.9 trillion bill. Still piling up very quickly over the last 12 months, that's for sure. Alongside Lisa Bravitz. Tom Keene, you got a final word?
No, I don't have a final word. I'm just not as gloomy as everybody today.
I'm not gloomy either.
Pretty good.
Oh, really? You guys are going to pin it on me.
The outlook looks better.
Tots have won 4 in a row. John,
explain
Gareth, Tots have won 4 in a row.
We'll talk about Gareth in a moment.
Gloomy.
I promised you some time on Gareth, all right? This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance live on TV and radio for our audience worldwide. Here's the price action this Monday morning. Good morning. Good news is good news. Good news is bad news. Good news is good news for the banks, for energy companies. Good news is bad news for big tech. Let me show you what I mean by that. Nasdaq futures off by 1.34%. Yields are higher, eating into the tech names, and the weighting of big tech on the S&P and the Nasdaq is massive. Switch up the board. Good news is good news. Yields higher. Real yields higher. Good news is bad news for who? For Italy, for Europe. Look at this, the 10-year yield on the month up 42 basis points on treasuries, on gilts up 27, on an Italian 10-year up 22. Things are good in the US, things are getting better in the UK. Are things better in Italy? Not yet. So the ECB is starting to push back. Fabio Panetta of the ECB board in the last week or so, maybe these speech, the comments that you need to pay attention to, that the tightening that we're seeing in the United States and the UK is warranted. In Italy, it is unwarranted. Finish on this, switch up the board and get to the FX market. It's the story, arguably, of this morning. Yields are higher, and it's finally starting to drive a stronger dollar through G10 and through EM. And there is the euro. Tom Keene, a euro with a 118 handle. Euro dollar 118.69 going into Thursday with the ECB and President Lagarde.
Not too much gamma yet. I mean, not too much acceleration. But, John, you got to watch this carefully. I'm watching euro-yen. Take out the dollar, the relationship of euro-yen to see how that balances out. It's Monday. You wonder where that will be Wednesday.
Yep, and the spread between tens in Italy, Germany, and the spread between Germany and the United States. Mohamed El-Erian out on Twitter in the last 30 minutes or so. That spread getting wider and wider. More still to come on that with your movers. Here's Romain.
All right, John, I'm going to start off with the news across the wire a little bit a while ago here. Actually, I'll start out here with General Electric and AerCap Holdings. A couple of big deals, of course, out there right now. GE, of course, apparently in talks with AerCap. This is the big Irish leasing company to actually combine their two aircraft leasing businesses into one. This is a huge deal for both companies, which, of course, been looking to sort of streamline their operations, much more so for GE. This is also going to be a big deal for AerCap, and that's one of the reasons why you're seeing its U.S. shares here up even more so here in the pre-market. I think we can flip up the board. Not sure what we have next, but the other big deal, of course, out there was that, there it is, that's the Apollo deal for Athene Holdings. This is a big deal. I know you're going to have Sonali Basak on a little bit to get deeper into the weeds here. This is so much more than just about the price of this deal and what it does for the stocks. This is really about the control of Apollo and the direction that it's going. Remember, Athene is basically a creation of Apollo going back, 10 years or so. And of course, it went public back in 2016. Bringing this fully under the umbrella is going to give Mark Rowan and the rest of that team there a lot more control over the cash flow coming out of that. And then flip up the board a couple other stocks just to keep an eye on here in the morning. Of course, all the oil stocks right now, a lot of volatility there. Well, of course, everything that's going on from last week is OPEC Plus, and then, of course, that thwarted attack on one of those key Saudi export facilities capabilities, really has a lot of the oil companies moving all over the map here. Open Door Technology down for a fourth straight day. It looks like it's going to be. That stock down 30% here over the previous 3 days. And Adaptec, a big news there. COVID testing company finally getting emergency authorization there, Tom.
Romain, thanks so much. And I know NASDAQ 100 coming in, it was negative 2%, now negative 1.5%, so a little better tape off where we were 2 hours ago. On Apollo and Athene, Shonali Basak joins us right now. Apollo has very much been in the news, and Athene is the complete opposite. It is the path from Eli Broden, Sun America, through Jim Belardi, to the building out of a quiet, conservative, traditional business. Shonali Basak joins us right now, our chief Wall Street correspondent. Shonali, was there any surprise here? They already had the investment management arm. Is this just a done deal moving forward?
Yeah, that's a great question, Tom, because yes, it is. This was something that people saw coming for a long time, but Apollo is more closely linked to an insurance company, a highly regulated entity, but it is now one of the largest fixed annuity providers in the country. It does cement those earnings. Remember, it had accounted for more than a fifth, almost a fourth of Apollo's earnings.
You know, I look at the history of this and the honor of speaking with Mr. Broad years ago about his development of Sun America, which was shockingly profitable in the heydays of annuities. My first reaction, Shonali, when I saw this, is this a new, after Leon Black, Apollo that is going to become a more conservative Apollo in terms of their financial statements?
Yes, in some ways, because they are eliminating a lot of their shares of classes, right? They have 3 different shares. That means the founders will also be like everybody else. It's a one vote, one share. So Apollo's corporate governance will be simplified, Tom. But can I tell you something? It's not just about this wonky business of annuities. Athene is a major owner and originator of credit assets now really around the world. You see them in talks to buy those Greensill assets, for example. Apollo wants to own the way that credit is originated.
Shonali, thank you so much for the brief. Much more. Ms. Basak will be across all of Bloomberg today on this important transaction for global at Wall Street. Another important transaction is in the fixed income space. John Farrow, you know it. It's been priced down and yield up.
Let's talk about credit. Let's talk about debt. Your yield on a 10-year, 160, up 3 basis points. The path to 2%. Subhadra Rajappa joining us now, Societe Generale head of U.S. rate strategy. Subhadra, walk us through the call, the road to 2%.
Well, we're getting a tremendous amount of fiscal support, and you covered this earlier on in your program. 1.9 trillion to be passed this week. We'll probably get another tranche of 2 to 3 trillion in both green initiatives as well as infrastructure spending. So I think that should, there's going to be a tremendous amount of fiscal stimulus that's going to justify higher yields. Fundamentals are strong. I think GDP this year is going to be very strong, much higher than people expect, probably in the realm of 6% or so. You're also looking at financial conditions, at least thus far, have been somewhat accommodative. And the Fed seems to be not so worried about rising interest rates. So I think given the sort of backdrop, it makes sense that yields start to drift higher. Although we believe that the pace in the rise in yields in the second half is probably going to moderate. You're not going to see the sort of dramatic rise we saw in the first 2 months.
Subhadra, when does it become a buying opportunity?
That really depends a lot on where the Fed thinks or how the market reacts to higher yields. Probably, if you look at sort of the longer run, terminal Fed funds rate, the Fed's expecting, longer run rates to be around 2.5%. But I think well before that, you're going to start seeing demand, especially from perhaps overseas accounts, given the fact that the yield differential between the U.S. and other countries is quite wide. So there'll be some opportunities for foreign investors to come in and step in to take down this sort of rise in yields. So I'm thinking 1.75 to 2%, you might see some resistance and some sort of a demand, I would say, for Treasury 10 years at that level.
Subhadra, you also said that so far credit conditions have remained very loose. The financial conditions remain incredibly accommodative. It's starting on the margins to show a different tone. You've seen outflows from credit accelerate. You've seen, for example, the worst quarterly performance, if it continues this way, for investment-grade credit in the U.S. going back to 2008. At what point does this get your concerned? What point do you think that this actually counts as tightening financial conditions for the Federal Reserve?
So that's a very, very good question. And I think that what you typically tend to see in past tantrums is that there's a delay between the rise in yields and the impact in things like the corporate bond spreads and credit spreads and the dollar. And we might be at that phase right now where we've seen the sharp rise in yields, but corporate bond spreads haven't started widening. And if we do see that trend towards sort of stronger dollar, ever so slowly widening corporate bond spreads, I think that definitely is going to be a concern for the Fed, because these two factors are going to tighten financial conditions. So as of now, there's no concern, but we'll have to see how this evolves in the coming weeks to see if this actually becomes something that will tighten financial conditions.
Well, here's the call from Bank of America. Quote, we are now going tactically underweight U.S. investment-grade corporate bonds. Quote, we expect spreads to widen and join the tightening of financial conditions, ultimately forcing the Fed to respond. So, Badra, do you envision a 1.75 to 2% U.S. 10-year without leading to that kind of event?
So the key risk to our higher yields from here on is the Fed. I mean, the Fed has a lot of tools in its playbook to be able to manage both front-end yields as well as back-end yields. So the question is, when do they actually step in and respond? Right now, they seem to be very comfortable with the trajectory of yields because they feel it reflects the fundamentals of the economy, higher growth, higher inflation. But I think as we start seeing perhaps unruly behavior in the bond market, sort of tightening of financial conditions, they're definitely going to step in, and they have a lot of tools in place. So that is the key risk to whether we get to 2% or not, because the Fed can step in any time to prevent the rise in yields.
Subhadra, always good to see you. Thank you. Subhadra Rajappa, Societe Generale, head of US rate strategy, on the road to 2% on a US 10-year.
Yeah,
and I find the conversation amazing that you come out with a forecast, you put all this effort in. If you're a Soc Gen looking for 2%, I believe Bank of America, Morgan Stanley looking for something in and around 175. But your key risk is the decision of the Federal Reserve and whether they like it or not.
Yeah, but I'll go on. And Neil Dutta had a note out on this a number of minutes ago, John. The idea here of being overwhelmed by economic growth, I get it. To me, it's a bear market in bonds. Price down, yield up. I know that's really sophisticated, but it's not wrapped around a recession or wrapped around tepid economic growth.
Not at all.
Everybody's framing 6. I mean, I thought Abby Joseph Cohen was something there with HOTC as his reaffirmation of Western 7% growth.
I don't believe it's the Fed's job to bail out growth equities.
Exactly.
Let's be clear about that. But if it leads to a broad-based tightening of financial conditions, credit spreads wider, high yield, investment grade, then the Fed's got a problem they might have to respond to.
On International Women's Day, John, I want the three of us to sort of mention the one woman that really moved us forward. John, I was 17 years old, and I was in over my head aerospace engineering at the height of the Apollo program, and I ran into Ruth Rebecca Struick. She is 89 and holding. She is healthy out in Boulder, Colorado, and Ruth Rebecca Struick in mathematics changed my life. She was just a light there. Let me tell you, John, I was as lost at 17 as you were. That's hard to believe.
I'm still lost on that subject now, Tom. I want to know more about Tom Keene, the student. We need to get Mrs. Struick on the program, Tom.
Well, she's a little fragile. She's a giant. Her father, George Struick, literally invented modern spherical geometry. This is wicked nerdy stuff, but she was lights out influential for me.
Very cool. Tom Keene, Lisa Bravis, Jonathan Ferro. Coming up, Dr. Deborah Fuller, University of Washington School of Medicine, microbiology professor. Futures down 26, off by 0.7%. For our audience worldwide, an ECB decision Thursday, some data through the week, and some big bond auctions as well. A lot of supply, 10s and 30s. Stay tuned for that. Down 26, we're off by 0.7%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Apollo Global Management has agreed to buy retirement services company Athene Holding. The all-stock deal values Athene at about $11 billion. That represents a premium of more than 16% to its closing price on Friday. Apollo was already Athene's biggest shareholder. The transaction is expected to more than double Apollo's reported earnings from last year. Senate Democrats made some changes to President Biden's stimulus bill, mostly to appease moderates and comply with parliamentary rules. But those changes aren't likely to keep the measure from sailing through the House tomorrow. It's still expected to be a tight vote. House Speaker Nancy Pelosi can afford to have only 4 Democrats oppose the bill and have it pass. President Biden will formally create a gender policy council within the White House. It's part of 2 executive orders he intends to sign today to mark International Women's Day. He'll also ask the Education Department to re-examine the Trump administration's policies and rulemaking on Title IX. That's the law which governs the way sex-based discrimination in schools is handled. The U.S. and South Korea have reached a long-sought-after agreement on defense costs. The result, Seoul will pay more for the U.S. troops stationed in the country. South Korea's parliament still has to ratify the deal. Talks stalled last year when Donald Trump rejected a South Korean proposal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Conversation with ARK Investment CEO, CIO, and founder Kathy Wood. 5 p.m. Wall Street time on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
More than ever today, with the whole world affected by the pandemic, we see how much we need each other. Everybody is affected, and we would need to cooperate to come out of it together. And that's why all the efforts done by national governments, finance ministries, and so on has to be complemented by international cooperation in order to help us restore our economies.
That was Cecilia Malmström, the former EU Trade Commissioner and candidate to lead the OECD. From New York City this morning, good morning, alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. The economy and the outlook for that economy gets better and better, and this administration throws $1.9 trillion at it. The House could seal that bill, then it gets signed away. Your bond market yields up 3 basis points to almost 160 on 10s now. Your dollar is stronger. That's got to be the story this morning. Euro dollar breaking down to 118.63, down 0.4%. Tom, I know you're always on peso watch. The peso is weaker, the rand is weaker. I know much more so for you, you're on lira watch. Turkish lira weaker by more than 2%.
Well, yeah, lira's got its own religion here. It's still idiosyncratic. But, John, can you imagine a 117 euro? I mean, how do you adapt to that?
Right now, I can imagine it, yeah. 118 down to 117. And I think this administration has really pushed things forward, Tom, and pushed this bond market to really think about what this economy looks like. We've had the expectations for growth in America shift from just south of 5% to 5.5% in the matter of a couple of weeks. If you follow the economics and the economic forecast that we do at Bloomberg, that median estimate, Tom, has really pushed out over the last couple of weeks and could go up again.
Well, we'll have to see. And, of course, it begins an eventful week here as everybody starts to lean towards a Federal Reserve meeting, I believe, March 17th. On International Women's Day, we have been flattered by how our team has gotten us some important voices. Abby Joseph Cohen on the markets, Elizabeth Economy on China, and now Deborah Fuller from the #1 microbiology platform in America, that is all known as the University of Washington and their School of Medicine and Microbiology, where she provides important research leadership. We're thrilled she could bring us up to date on the pandemic. Deborah Fuller, there's so many looking at the clear and present. You and your leadership at Washington are trying to figure out where we'll be on COVID 2 years from now, 5 years from now, and even indeed out to 2031. How do we prepare for the next virus?
Right. So right now we're doing great against the current viruses, but as we can see that we're constantly battling new variants that are coming out already. The manufacturers, J&J, Moderna, and Pfizer, they're updating their vaccines to combat the next one to come. And so we're going to enter into a cycle that would be similar to flu, where we're just going to have to constantly get another update. And always lingering in the background would be the potential that a new variant could emerge that could cause yet another pandemic. That's the case for flu, and that's the case for coronaviruses. So what we're working on is really thinking about the future is really about developing what we would call a pan-coronavirus vaccine, one that would be able to induce immune responses against parts of the virus that are very conserved and allow us to have immunity against not just the current variants, but future variants to come and provide us protection against a future pandemic.
Are we constrained because we don't have an efficacious vaccine that can go worldwide and particularly to worldwide impoverished areas, that we don't need the refrigeration or the fanciness of mRNA vaccines? Do we need to get to a basic vaccine?
Absolutely. I have always said that the ideal pandemic vaccine is one that could be stored at room temperature and administered in a single shot, and ideally self-administered. That is really the way to effectively and rapidly distribute and get a vaccine quickly worldwide into both poor as well as wealthy countries. That's another area that we're working on. We're working on a room temperature stable nucleic acid vaccine that's actually based on DNA rather than RNA, because that's much more stable, and one that can be self-administered without a needle and syringe.
I was about to say, self-administered with a needle might be a different proposition, Dr. Fuller. Perhaps people wouldn't be that excited about that. There is a question, though, whether the mRNA technology has shortened the time from the discovery of how to combat a new strain of either coronavirus or some other virus to actually getting vaccines rolled out and into people's arms. How much have we shortened the vaccine rollout?
Oh, substantially with the RNA vaccines as well as the new viral vector vaccines that J&J is developing enables really rapid update because you only need the sequence of whatever variant is emerging. Traditionally, vaccines would take 8-9 months to update. With these new technologies, we're looking at 8-9 weeks to be able to update and then roll out a new version.
Dr. Fuller, how different are these vaccines from one another, based on this idea that a lot of officials are trying to prevent people from vaccine shopping, and yet there have been different efficacy rates?
Right. The efficacy rates are really based on the fact that the vaccines were tested at really different times. The Moderna and Pfizer mRNA vaccines were tested when the first variants emerged. And these vaccines, all three vaccines, were designed to combat that initial variant. So the RNA vaccines were actually the world variant was stacked in favor of making those look actually better, because when you have a vaccine that is a better match to the current variant, you're going to get better efficacy. So J&J, by the time they got to their clinical trial, the variants had emerged. And so the differences, I think, in the efficacy, you really can't interpret that to mean that one vaccine is better than the other. What's really important is if you look at real world impact, what we're seeing is all three of these vaccines have a profound impact in protecting against severe disease and death. I mean, we're close to 100% protection from death, and that's really what's important. That's what we're after with vaccines, is to get it to a point where we don't have to be afraid of the high mortality rate of this virus.
Hopefully that point is very close. Doctor, thanks for your time today. Dr. Deborah Fuller there, the University of Washington School of Medicine professor. You just got the feeling when that headline came out back in early November that things were about to change, and change quickly, and this market just raced away with it. Small caps since then, the Russell, are more than 42% from the end of October, Tom. Unreal.
And so importantly, John, we've pulled back barely such, and that's because I think there's an acceleration of the good news in America, and it's almost unimaginable if we continue that acceleration where we'll be, John, in 30 days.
Look at the numbers, Lisa. 9.2% fully vaccinated in America, 17.7% of the population at least one shot, and we're doing this at a clip of what now? On average, 2 million plus a day?
Yeah.
We're racing away here.
Yeah, but it's a real delicate job when it comes to messaging, because we're also getting a racing to reopen, as you've talked about Texas, you've talked about other states as well. I mean, even in New York, you're seeing an increase in capacity in restaurants at a time when you do have new variants starting to spread, and you have health officials. I keep going back to Tony Fauci. He was really adamant, saying it's not looking good. We don't want to get complacent with 70,000 new cases diagnosed every day.
Should we push forward to the next hour? What a lineup we've got coming up for you. On the bond market, Kathy Jones. On the commodity market, Amrita Sen. On the economy, Michelle Meyer.
Wow.
And Henrietta Trays on China and all things Washington, D.C., Tom, in the next hour on this show.
Yeah, an incredibly strong lineup there across all the assets that we like to do to brief people on radio and TV Monday. I'm really interested in what Kathy Jones sees, what people are doing at Schwab.
Looking forward to that conversation with Tom Keene, Lisa Gravitz. I'm Jonathan Ferro. Your equity market heading south for big tech. The why? The key to that's in the bond market and a monster fiscal plan down in Washington. 160 on a US 10-year. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Are going to keep rising until we get that disorderly market functioning.
If the Fed starts talking about tapering their asset purchase program, I think that'll be negative for risk assets.
The market is looking for any positive data in order to continue to justify this march higher.
There is a very strong correlation between the last two rounds of stimulus checks and the inversion you're seeing.
Half of the market wants to have better job data, and the other half of the market is scared of that because of the potential inflationary consequences.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast this Monday on radio, on television, nationwide, indeed around the world. It is International Women's Day. We'll have much on that with a sterling set of guests through this hour and, frankly, across all of Bloomberg today. A wonderful effort by our bookings team. John, we have to talk foreign exchange as the center point. Michelle Meyer, Kathy Jones, Amrita Sen. You got to look at a dollar advancing.
American exceptionalism, a dollar with a 92 handle on the dollar index. The Y, yields are high, the outlook's better. Tom, that's the story. Higher real yields finally starting to bite into that huge short position in the US dollar coming into 21.
And finally starting to bite, and I would suggest, John, a 160 on this Monday is different than a 160 10-year yield that we saw a bit ago.
Better news and a better outlook. 162, I think, on Friday off the back of that better payrolls report. But Tom, we said straight after it, are you ready for bigger numbers? Because they're going to be bigger. Texas is reopening, others will follow, and we've just thrown 1.9 trillion at this, Tom. These numbers will be big, and we're also sending people $1,400 checks. You saw the retail sales print for January. Right. What do you think that looks like in the next few months?
Well, it looks like big GDP, and certainly we're seeing that from economists ratcheting up. Abby Joseph Cohen earlier re-emphasizing Jan Hatzius's optimism on Western GDP growth. Lisa, I look at the set of realities out there, and it's amazing how $1.9 trillion can support an economy.
It can support the U.S. economy. Can it support the global economy?
Yep,
and here is the key question right now, because especially as you see the dollar strengthen and you see the biggest sell-off for emerging market currencies today going back to last March, you have to wonder, how much does this pull money from some of the riskier areas in markets, from some of the riskier areas in the world, and put them back in the United States, because that's where people want to be and because yields are rising. And this creates, John, a fundamental question for, frankly, the Federal Reserve. They want to be the central bank to the United States, but they really are the central bank to the world in many capacities.
Well, there's the headline right now out of India, Tom, as the third bond issue pulled because of what is happening with yields in the past week. So you see that out of India this morning. You're seeing the worries over in Europe and the undue tightening, in the words of several ECB officials, and it sets up for a fascinating meeting on Thursday. I said this a couple of weeks back. When Chairman Powell sat there in the semi-annual testimony to Congress and talked about the warranted move, the statement of confidence that he saw Treasury yields shifting higher, I thought about that, Lisa. This was a central banker for America, and no surprise, he's sitting across from Congress. But over the years, it's been the central banker to the world, and the why is just this feedback loop, that this tightening of financial conditions globally becomes a concern at some point. Tom, we're not there yet. I have no idea if we get there soon, but that's the worry. You look internationally, they don't like this.
Data check and then our esteemed guest. But first, Lisa, what do we see in the other bond market? We're all full faith in credit, but what are corporates and high yields doing?
You're seeing a similar type of trend as you saw in the emerging market space, but less pronounced. Basically, you saw some of the biggest outflows since the disruption in last March from high yield, from investment grade, but still yields are pretty low. But today, there's an American Airlines offering of debt because they're trying to get in before the window closes, and you're seeing people accelerate their fundraising because they do see yields going higher.
We're going to do a data check now. John Farrell's going to do bonds here in a moment. The real yield was so influential on Friday, the electric grid east of the Mississippi dimmed there about 1 p.m. Futures negative 25, Dow futures negative 47. We do that in Dow points, 31,419. The VIX up to almost 3 big figures, 27.36. We mentioned stronger dollar. Oil, yes, off the news of Saudi and the issues in Yemen, 69.12 on Brent. John, what do you see in the bond market?
I see you trying to push my buttons. That's what I see. Your 10-year yield, 160 on a 10-year right now, 159.77. The high of the session on Friday, just north of 162. Tom, I said when we went through 130, 140, it'd take me a while to get used to these levels. You have to get used to them quick because this bond market kicks higher very quickly.
And what is so important here is it's not just about yield. There is a point, as Liz Goldenberg lectured me years ago, where you switch from yield to a price analysis. Kathy Jones at Schwab Center for Financial Research knows this very well. She watches the flows of what people are doing with their money. And Kathy, I calculate from the end of August, I have a 10-year yield down a good amount in price, 8.3% down in price. Are we heading for a bond bear market?
You know, I think we could be over the long run. I certainly think that the lows that we put in, those very, very low yields, around 0.5% on the 10-year, or I think 1/3 of 1% on the 10-year, is probably the low for a long time. But bear market is, you know, price over time or yield over time. So if we're looking out 2 to 5 years down the road, yeah, I think that yields continue to go higher as long as the economy does recover from the COVID-19 crisis as it continues to do. But the magnitude of the move from here is not likely to be nearly as fast or as great, I think, in the next leg as it has been from that previous low.
Kathy, we discussed so many times about how self-limiting a move higher would be because of the amount of debt that we've added to this economy. I remember in and around 1% talking about 120, maybe it was 125, maybe it was 150. We're at 160 right now. Where is it in your mind?
Well, you know, 160 was our target coming into the year. And now that we're here, we do start to see a little bit of that pushback from the risk markets and risk assets. But certainly yields are not so high that we're going to see a huge economic deterioration from here unless we start to see credit spreads blow out or something like that. But, you know, you push up towards positive real rates in the 2% plus area, and then we're probably going to see a negative feedback loop work its way through. You know, you have a lot of companies, the smaller, low-rated, unrated companies, the zombie companies that have been rolling over debt for a long time. Their ability to continue to do that if rates push up another 40, 50 basis points is going to be challenged.
Wait, that's important. Another 40, 50 basis points. That's all it would take for some of these companies to face true financing pressures. You're talking about in the high-yield space in particular.
Yeah, no, we just did an analysis of some of the zombie companies. Now, it's hard to get really good data, but a lot of have been really living on fumes. And so, you know, if you look at the private debt area, the really low-rated bonds, they're going to be challenged unless the conditions change in terms of revenue flow from here.
The reason why this is such an important point, Kathy, is because people have come on this show and others and said that the real risk is for rates increasing, right, is duration and not credit, because credit looks good given the backdrop that we have in the easy financing conditions. Are you saying that that story is changing, that credit is starting to matter that much more? Because as you get that rise in interest rates, some of these credits are that much more sensitive to any tightening, let alone 40, 50 basis points.
Well, I think you have to differentiate between, say, you know, investment grade, where we've seen a sell-off in the investment grade market basically because of duration, not credit risk, right? And we're not worried about IG. Even in the higher rated part of high yield, we're not worried as much because this is a potent combination of easy fiscal, a very accommodative monetary policy and very expansive fiscal policy that's good for credit. But when you get into the lower rated credits, where you've seen this big buildup of debt and the lack of earnings that we've seen, unless they start to kick in on those earnings, we're going to see some deterioration there.
Well, Kathy, we have to talk about the next logical question then, and that's the maturity wall, funding requirements. And from what we've seen in the last 12 months is an extension of the average maturity for so many of these companies because funding conditions have been so good. Is there a maturity wall on the horizon? I haven't heard about it. Do you see it?
Yeah, I don't have an estimate of maturity wall that we're particularly worried about at this stage of the game. There is a lot of debt buildup, and we're certainly going to face some financing problems down the road, but I think it continues to get pushed out. So that's not something we're worried about for this year or even early next year.
Kathy, always good to see you. As always, Kathy Jones of the Schwab Center for Financial Research. And that's got to be the story here, guys. Yes, yields might be higher, but growth's going to be better. So the income for so many of these companies should improve as well. And on the maturity wall, the average maturity has been extended by so much over the last 12 months.
Although there is a question about whether improved growth means that the Fed can step away and not backstop everybody, John. And so then all of a sudden you start to see more bankruptcies. And people say that that's actually a sign of a healthier market where not everybody is kept afloat. And so some of these companies could run into more trouble and particularly see higher funding costs that go up prematurely in anticipation of that.
Well, the backstop is implicit now, isn't it?
Is it?
Even if they step away in terms of actual policy, isn't it just hanging over there, over this market forever now, Tom? We know what they did last time and we know what they can do again. Isn't that the story now?
They have a power, and they're going to adapt and adjust to fiscal. What they're really going to do, John, is delay. The Fed is expert at delaying, just waiting and waiting and waiting, and they've got a scheduled set of meetings where they can wait to do that.
But there's a difference between backstopping an entire market during a period of distress and backstopping specific names that run into trouble, John, because of fundamental problems. And I think that is the differential that people are concerned about as we head into a more normal time.
I think, John, what Chairman Powell's concerned about is getting weekly claims from 800,000 down to 500,000.
And the rest.
It's a different world.
And the rest,
when
Tom.
we're there.
And the rest. I think they're going to be waiting a long, long time before they do absolutely anything. Look, there is a conversation about them maybe blinking at some point when this data really starts to improve in several months' time. And that's what's going to be fascinating. We know the trajectory for economic data. We know what that's going to look like, just the mechanics of this as we reopen, and then we throw fuel on top of it. What's going to be interesting is how this market responds to this and how the perceptions of policy changes adapt as well.
And within all this excitement, John, I look at the single sentence of the research warning, and it's from Christopher Verona, strategist, always prescient on the trends in the markets. And I love what he says, momentum is fatigued. I think that captures it perfectly, John.
Chris was on last week. We've got to get him back soon. Coming up, Henrietta Trace, Veda Partners Director of Economic Policy, on everything down in Washington, D.C. Just a massive plan, 1.9 trillion. It's big. Is it too big? We're down 20 on the S&P. We're negative 0.5%. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Apollo Global Management has agreed to buy retirement services company Athene Holding. The all-stock deal values Athene at about $11 billion. That represents a premium of more than 16% to its closing price Friday. Apollo was already Athene's biggest shareholder, and the transaction is expected to more than double Apollo's reported earnings from last year. Bloomberg's learned that GameStop is tapping the founder of Chewy.com to guide the company's transition to an e-commerce business. Ryan Cohen already is a board member at the video game retailer. He will chair a new board committee that will be in charge of GameStop's transformation. Democratic lawmakers predict that President Biden's $1.9 trillion stimulus bill will sail through the House tomorrow. The Senate made changes to the bill to appease moderates and comply with parliamentary rules, but those changes are unlikely to prove enough to make progressive Democrats vote against the measure. And Goldman Sachs predicts the U.S. is on track for an employment boom this year. Chief economist Jan Hatzius says that reopening the economy, fiscal stimulus, and pent-up savings should fuel very strong demand growth. Hatzius and his colleagues say the jobless rate will fall from the current 6.2% to 4.1% by the end of the year. And Elon Musk is getting into the Texas power market. He's building a gigantic battery connected to an ailing electric grid outside of Houston that nearly collapsed last month. The move marks Tesla's first major foray into the epicenter of the U.S. energy economy. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
When we took office 45 days ago, I promised the American people that help was on the way. Today, I can say we've taken one more giant step forward in delivering on that promise that help was on the way.
Help is on the way. The President of the United States talking up a $1.9 trillion plan out of this administration, very close to being signed off on. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. Here's your price action this Monday morning. Equities down 14. We recover 38.25 on the S&P. We're down just 0.4%. The Nasdaq's still a struggle. Still a struggle, Tom, with a 10-year at 160, 159.77, yields up 3 basis points. And I want to sit on that Goldman forecast just for a second on unemployment. They're looking for 4.1% by the end of the year. We bottomed out in the last cycle at 3.5%. And what's unique about this particular crisis is just the speed of the downturn and the speed of the expected recovery. Tom, to see 4.1% by the end of the year, that's the Goldman call. Let's go to the Fed just quickly. The Fed forecast on a Bloomberg terminal. This is what they look like on GDP and on unemployment. GDP for 21, 4.2%. For unemployment, 5%. So that's almost 1 full percentage point beneath where the Fed is. And on growth, the Fed's at 4.2. And right now, economists are looking for 5.5. And we've talked about the 6.5% from the wonderful Ellen Zentner over at Morgan Stanley. So what's due on March 17th, Tom? Some real forecast revisions to be expected here from the Fed in the next couple of meetings.
We get the revisions, but what is important to me, John, is the dovetail here of David Kostin with Jan Hatzius, as Abby Joseph Cohen mentioned earlier. Everybody's coalescing around this growth input.
Better growth, lower unemployment, and a Fed, and here's the key part, a Fed that's going to sit it out.
And they're going to sit it out and wait. And
that's the change.
And they'll get back to reasonable employment, and then we'll move on. Right now on the policy forward, Henrietta Trays joins us. Too short a visit last time. We'll try to do it longer here with Veda Partners. Henrietta, I want to go right on to infrastructure. In what you learned in the stimulus process, do the committees matter? As we go out to another $1.5 trillion, $2 trillion, $2.5 trillion of infrastructure over 10 years, does the committee process matter?
That's such a fascinating question. I was actually speaking with some of the chief counsel on the Ways and Means Committee earlier this one specific reason. It allowed the Democrats to get almost all of their major policy changes enacted via reconciliation. So they saw that blueprint, they found that path, and effectively they're going to move in that same direction. And it's helpful for investors because we have, real hearings. You can see exactly what's going to be in the infrastructure package through that live process. Are we going to see the Green Act and all those tax credits be included? I think it's a huge component here. Well put.
And John, I don't know what Parliament's like in London, but this is a huge deal to see us go back to some form of committee process.
Overwhelmingly, the whole process has been a huge deal. But this market's been trading on this since the Georgia runoffs, Henrietta. And I said earlier on the program that we're already moving on to the next thing before this has been signed off on. We're talking about infrastructure. How difficult will it be to get this done?
Absolutely. I've been holding conference calls with our clients and some staff in the Senate just on the macro side and the banking side, just to understand, what is the market pricing and where are these inflation fears coming from? And just as you point out, it's not this COVID bill that's just about to pass on Tuesday. It's that they're already moved on to the infrastructure package. The estimates on the street from folks we've spoken with are anywhere between $2 trillion and $4 trillion in spending. I think we need to do a little refresher course on how a bill becomes a law and understand that this one in particular will vacillate much more than the COVID relief package did. Biden put that plan out at $1.9 trillion. It come in at $1.889. That's an exact replica. This process on infrastructure is going to go from $4 trillion to $6 trillion and then all the way down to $2 trillion over the course of the next 3 to 6 months. And so the process is going to be integral in a way that it was not over the last 2 months.
Can we do that refresher course right now? There's that great scene, I think the movie Margin Call, where the guy at the top of the business comes down and says, talk to me like I'm a stupid Labrador and walk me through it. Can you do that right now for me?
What? You called me that last week.
Or maybe for Tom. Henrietta, help us understand what that process looks like over the next several months, because I think we all have to get familiar with it and quickly.
Absolutely. I'm happy to. So the brief rundown, it's best to go chronologically. We're going to get a State of the Union version of a speech from President Biden in the next 1 to 1.5 weeks. He's going to lay out the structure of the infrastructure bill just in verbiage there. And then around mid-April, we're going to get the fiscal year 2022 budget that will give us clear parameters of how much money the president wants to spend, what deficit appetite is, what we can expect from the administration here. The Democratic Conference has made it clear that they will be following the lead of the administration. So again, the first thing we'll get is the speech, and then mid-April we'll get the budget. Shortly thereafter, the House and the Senate will need to pass their own reconciled budgets that will be exact replicas of one another. That will also tell us 3 key things. 1, what is the components of this infrastructure bill? Will China be involved? Will energy tax credits for electric vehicles be involved, et cetera? Number 2, how much money are you going to spend? What is the deficit appetite in Congress post this COVID bill? And then that
tell us is when will this bill need to be presented House and Senate for a vote. From there, we'll move ahead with the committee process. As you point out, we'll see the Energy and Infrastructure committees weigh in with their components. Their goal is by Memorial Day to have those, 100-page documents and bills finalized. That's the real meat and potatoes of this package. And then we'll be working with the July deadline first. As you know, they go on recess throughout August and into September 20th. So they've on, 7 or so weeks of recess. They want to right now get this bill done before July 30th. So the process is budget in April, bill in May, bill passes on the House and Senate floor by July. That's their trajectory right now.
Henrietta, you make it sound easy. We both know it's not. Henrietta Trace of Vader Partners. Looking forward to the ongoing conversation on this issue. It's the race to July, Lisa Bramvis, and another multi-trillion-dollar plan out of D.C.
Yeah, but to sort of dovetail the points that you were making about the Federal Reserve and the type of employment, that it wasn't just the unemployment rate, it was also the inequality that we've seen in it. How much is that a driving force behind the infrastructure spending plan? I mean, really, what is the goal with the infrastructure spending plan? Is it to just build a better network for the United States, or is it also something having to do with income inequality? And this is a huge debate to be had in Washington,
Yeah, it's not going to be a battle just about the numbers, Tom. It's going to be a battle about how it's calibrated and where the cash goes. That's for sure.
Yeah, well, where the cash goes is important. And again, I'm going to go back to the fundamental economic growth. John, you read that, margin call. I thought, Zachary Quinto, I thought you were in that movie there for a while when, he plays Peter Sullivan and he gets the little stick there, when they figure out mortgage volatility.
It's a great movie.
Based that on you, didn't they?
What was the chairman of the bank? What's his name? Irons.
Jeremy Irons.
Jeremy Irons.
Yeah, what's his name? Irons.
You knew
Jeremy
he'd go
Irons.
off on this. You knew that this would be the subject
Lisa,
of another 2
let me
minutes.
tell
You knew that would be the case.
I'm so happy with one thing this morning.
Why you brought that
2
up.
hours and 25 minutes into this program, and Tom hasn't mentioned the one thing that happened last night that honestly I thought you'd open the show with.
I thought so too.
I'm happy you haven't done that, and I'm right up against the commercial break, so you can't really do it now
Well
either.
done, John.
I talked to Megan and I said, we
Megan.
really play it low key.
Megan, the floor manager, or you spoke to Megan?
Megan, the other one.
Okay.
But Megan was cast for margin call, but wasn't in it.
I haven't seen it. I'm not going to watch it either. Coming up, Michelle Meyer, Bank of America Securities Head of U.S. Economics from New York City this morning. Good morning to you all, alongside Tom Keene, Lisa Bramvis. I'm Jonathan Ferro, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
From New York City, for our audience worldwide, this is Bloomberg Surveillance live on TV and radio, and here's the price action going into the Monday opening bell, 1 hour away. Futures come in by about 0.1% on the S&P. We're well off the lows on the Nasdaq, still down 0.7% on the session. The relative underperformance, though, last week just told the story, didn't it? Up 0.8% on the S&P, down by almost 1.9 on the Nasdaq. And the why is just the compositional story, the member weightings, the big tech story getting smacked around by this. Switch up the board into the bond market. 2s, 10s, 30s, better data, higher yields. We saw 162 on Friday this morning. We saw 160 briefly, 158.72 is where we are right now. Look out Wednesday, 10-year supply. Look out Thursday, 30-year supply after that ugly 7-year auction from 2 years ago, 2 weeks ago rather, feels like 2 years ago. Finish on this, financial conditions. Here's the story for me and so many other people as well. Yields are backing up. Chairman Powell calls it a statement of confidence. Will he feel confident if this starts to turn around? And Tom, I think this is probably one of the most important charts of the moment. Right. Financial conditions. In the middle, bang, tighter, tighter, tighter. That's the pandemic. Then the Fed steps back in. Loose, 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 and they stay loose. Bank of America out this morning on the credit side, Tom, talking about the prospect of maybe that high yield story bleeding into credit, and those loose financial conditions start to get tighter, and that's the trigger point for this Federal Reserve.
John, I'm so happy you bring this chart up. Let's stay on that chart if we could. This is one of the great triumphs of modern Bloomberg research. This is the Michael Rosenberg, the acclaimed Michael Rosenberg and his team. And John, they used that chart. They brought it out, and 2 weeks later, the IMF, the International Monetary Fund, put that chart in the Green Book, the Financial Stability Book. And John, what I see there is a lot of stability.
Stability. And the key here, Tom, is this Fed is not here to bail out growth equities and your longs into Tesla. And I know some people might think they are. If financial conditions start to tighten, though, because of what's happening in credit, Tom, that's a very, very different story to what we've seen over the last month or so.
In the mixes we see in stronger dollar this morning, red and green on the screen, a recovering market over the last 2 hours. We've had the great privilege of talking to those within the Ethan Harris shop at Bank of America Securities. As we mentioned with Dr. Harris the other day, Michelle Meyer has been absolutely brilliant over the years on the pulse of the American economy. She joins us here with her leadership, and not only that, but her symbolism of International Women's Day and getting it done. Michelle, you know, we have followed your career, and it's always narrow questions about this and that. I want to give you a broader question. What is the quality of U.S. 7.3% economic growth? What's the makeup of that big number you have Q4 to Q4?
Thanks, Tom, and thanks for the question, having me on today on an important day. So when you think about the drivers of U.S. economic growth, and particularly this year with a stunning, we're forecasting 7.3% growth when you measure it on that Q4 over Q4 basis. We think a lot of it has to do with the consumer. It has to do with the resolve of the consumer to spend and the ability of the consumer to spend. I mean, this is a household sector that is sitting on very strong balance sheets, that is sitting on a lot of dry powder in terms of the amount of cash that is accumulated and more to come, which as a result of the latest stimulus bill. And the consumer has already engaged. It's proven to be resilient, and we think there's a lot more to come in the coming months and quarters as the economy continues to move forward and it's reopening.
Michelle, do you think that the concerns have been overstated, that people have been hoarding cash simply to pay down debt going forward that's been deferred?
I think that has been overblown on an aggregate basis. I'm sure that is happening on a micro level, and you certainly see that in some of the narratives and in the anecdotes that are out there, but you're not seeing that on aggregate. I mean, when you think about the debt levels, we don't have that much debt to pay down. It's not the 2008 period where you had very, very, very much the case that there was excess debt, you needed to deleverage, households needed to clean up their balance sheets. It's not the case today. We entered this crisis, this pandemic, with pretty low debt ratios, historically low financial obligations ratios. And I think, yes, some of that excess cash will be going to pay down debt, but the majority will be able to be used in some form to be able to be kind of pumped back into the economy via spending.
Will the economy have the same sort of composition when people start pumping their money back in? In other words, 70% services, 30% goods, given that dynamic has shifted quite a bit during the pandemic. In other words, are we going back to normal, or is this going to be a new normal with perhaps more goods and fewer services just in general?
Well, I don't think we should assume that we're going to go back to the economy as it looked prior to the pandemic. Too much has changed in the world and in the economy in the last year. And I mean, certainly the embrace of more technology, the embrace of an online retailer that has now, shown itself through a variety of different categories and sectors to spend. But, when you think about the basket of spend right when the pandemic hit, yes, people were predominantly spending on goods because they couldn't spend on leisure and other types of services. Once they are able to spend on leisure and services, there will be a certain amount of demand that shows through for those categories. But that won't be the equilibrium either, right? We have to get past that pent-up demand, and then we'll figure out what that right balance is between goods and services.
Michelle, do you know what's so original about this moment? I'd love to get some insight into your conversations with clients. The bulls and bears both agree on where the data is going to be in about 4 months. They just disagree on how they think the Fed's going to respond to it in the months after that. When you speak to clients, how many of them, just roughly, just throw out a number, how many of them are convinced by the Fed's reaction function when data actually starts to pick up aggressively, when inflation starts to pick up too?
I would say the majority of clients we talk to have an appreciation for the Fed's reaction function in that they recognize it is different than the prior cycle, that this is not a Fed that is looking to normalize. This is not a Fed that's going to hike upon a falling unemployment rate. And it's not a Fed that's going to hike when they start to sniff out inflation. They are going to wait until the unemployment rate is below estimates of NARO, until you've reached that maximum employment measure. They're going to wait until you properly have the inflation. Right. But here's I think the distinction where there's a debate. It's what's the level of inflation, right? So is it that they need to say 2% inflation and they're going to want to get going, or will the Fed actually be able to tolerate something above?
Okay, guys. Hope you're okay today and you had a good weekend. I have news for you. If you want to sell short euro, it's a chance. We received right now signal to sell at 118.705. So I'm going to place an order to sell short at 118.705. All right. So you still have a chance to place an order because it moved down. Let's see what's going to happen with next candlestick. If it will move lower, I will have to cancel because this is day trading. This is not something I'm going to hold for several days or several weeks. I'm planning to make fast, quick profit on it. So if it will move lower, I will have to cancel the order. No, it's look like it moved up a little bit. Let's see what's going to happen. So at this moment, if you want to sell short euro, here's your chance. You can sell at 118.705. I'll speak to you later, guys.
So there's a lot of room for expansion still in those categories, leisure and hospitality. I mean, we saw that in the last jobs report. The majority of jobs created in the private sector were in leisure and hospitality, which was a payback from the decline we had seen in December and January in those categories. So before that, to get the Fed to think about a hike next year, you know, a lot would have to go very, very, very right. And again, we are forecasting a lot to go right. We are forecasting a very strong economy. But I think for the Fed to feel comfortable to lift off that quick, they would need to see the inflation cycle really, really speed up. Inflation expectations move up in a meaningful way. Wage growth showing signs, again, of increasing across the board. And that would convince them that inflation will be able to take off. And I'm just not convinced that will happen by the end of next year.
Michelle, tremendous, as always, and good to see you. Michelle Meyer there of Bank of America Securities on this better outlook, this better economy, and Tom Keene of Fed that won't be stepping back in for a while. All
the history of this is they wait and wait. It's the most comfortable thing they have. I go back to Timberlake of Georgia in his wonderful one volume. This is before Alan Meltzer's 2 volumes. And Richard Timberlake, John, made very clear the absolute singular tool any central bank has is to wait. Why is this bank any different?
Can I tease my show? Do I need permission?
Well, Lisa, what do you think?
I mean, are you going to actually, you're going to do it anyway, so go for it.
I'm going to do it anyway.
Come on.
Got a fantastic lineup. JP Morgan Asset Management's Oksana Aronoff on
you're
why
doing all men,
there
right?
might be too much debt.
Really, Tom?
Tom. Victoria Fernandez of Crossmark. Jill Carey Hall has been phenomenal on small caps over the last several months, and small caps have been the monster winner. And Emily Rowland, who's been really reluctant to invest internationally and has had that bias, that cyclical bias to the United States. So it's going to be a really interesting conversation about good news is good news for who. I'm looking forward to that coverage a little bit later on this morning. I'm going to run. I believe in the next segment you'll be talking about the royal family and a certain interview that happened last night.
Thanks a lot, John. Seriously? No,
I'm going to miss. Tom wants the information from the royal correspondent. Lisa, you are now the royal
I'm reading the
correspondent.
Star. Hey, what can I say? I'm reading the Star.
There you go.
You did have permission to do your tease.
I'm looking
all over
forward to the summary of the Daily Star and Tom Keene coming up very shortly. From New York City for our audience worldwide this morning, good morning to you all. Really interesting time for financial markets, and one that will be written about for a long, long time. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senate Democrats made some changes to President Biden's stimulus bill, mostly to appease moderates and comply with parliamentary rules. But those changes aren't likely to keep the measure from sailing through the House tomorrow. It's still expected to be a tight vote. House Speaker Nancy Pelosi can afford to have only 4 Democrats oppose the bill and have it pass. President Biden will formally create a gender policy council within the White House. It's part of 2 executive orders he intends to sign today to mark International Women's Day. He'll also ask the Education Department to re-examine the Trump administration's policies and rulemaking on Title IX. That is the law which governs the way sex-based discrimination in schools is handled. The US and South Korea have reached a long sought-after agreement on defense costs. The result, Seoul will pay more for the US troops stationed in the country. South Korea's parliament still has to ratify the deal. Talks stalled last year when Donald Trump rejected a South Korean proposal. British food delivery company Deliveroo has kicked off an IPO in London. The offering could raise billions of dollars and put the UK market on track for its best ever first quarter. No details on the size of the IPO. Deliveroo is backed by Amazon. It was valued at more than $7 billion in its latest funding round. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Short position opened on euro, as you can see, at 118.705. So all of you guys who follow my trade and want to make a profit on euro against United States dollar, that's it. You entered new position, and I'll let you know when and how we're going to make a profit on it and when we're going to sell it. Good luck.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We might be at that phase right now where we've seen the sharp rise in yields, but corporate bond spreads haven't started widening. And if we do see that trend towards sort of stronger dollar, ever so slowly widening corporate bond spreads, I think that definitely is going to be a concern for the Fed.
Subhadra Rajappa, Societe Generale, head of U.S. rate strategy there with important comments. And we really, again, thank our team for wonderful, wonderful simulcast this morning, 3 hours, as we look at all the talents across economics, finance, and investment, and the women that add value each and every day. We finished strong with Amrita Sen of Energy Aspects, just wonderful last time on the dynamics of oil. And of course, Amrita Sen joining us here, given the news flow out of Saudi Arabia. Amrita, this island, this place in the Persian Gulf, distant from Riyadh, is, I believe, 7% of the world's refinery. Is it defendable, or is it a sitting duck?
I think it is defendable, Tom, especially after the upcake attacks. If you remember, in 2019, the U.S. has actually sent a lot more defense capability to help Saudi Arabia. And, that's why, despite the attacks, we actually haven't seen any impact on oil installations, tanks, and exports are continuing. Refining is also continuing, just like it was prior to the attack.
How important and who is that oil important to? If this area of the Persian Gulf was to be damaged in any way, who gets damaged?
I think the most important thing is that Ras Tanura, the region where the attack did take place, is 90% of Saudi exports. And, as you know, Saudi Arabia is the world's largest exporter of crude oil, and that would mainly impact Asian refiners. So India, China, Japan, Korea, Taiwan, really everybody in Asia. Of course, there's a decent amount going into Europe as well, very little into the US these days. But you are going to see a huge escalation. I mean, if it were to be impacted, and if you were to see Saudi exports reduced as a result, you would really get oil prices shoot higher, because you'd lose so much. Yes, Saudis have alternatives, but they just aren't big enough to offset 90% of its 6 million barrels per day of exports.
Right, and this is the reason why you saw Brent crude spike up, why you saw prices rise significantly, even though no production was actually taken offline, nobody was hurt, it wasn't necessarily anything tangible that happened, but it really indicates the marginal buyers or the marginal aspects affecting oil prices right now. Is it the concern about production coming offline at a time when you've got production cuts still in place and you have the question marks around shale production, or is it very much still on the demand side?
I think this is a great question, because, if you ask me, the reality is we still have a lot of spare capacity. We've got about 8 million barrels per day of spare capacity, including Iran. So you shouldn't see a knee-jerk upward reaction in prices despite any attacks, because Saudi Arabia can, in theory, bring back a lot more production. Arguably, yes, if export facilities are to be impacted, then even if production came back, they couldn't export it. But others could, right? UAE, Kuwait, Iraq, Russia. So there is spare capacity in the market. But what we saw last week from the OPEC Plus meeting is that Saudi Arabia in particular, but the group as a whole, remain extremely cautious, extremely reactive. They are not in any rush to bring those production barrels back, because they are saying, we want to see demand actually pick up. Yes, there's a lot of optimism around demand, but unless and until we see that in the numbers, we are actually not going to bring production back. We are not going to preempt anything. And I think that's why, while I don't think prices are going to go up very sharply because of the spare capacity, the market is still very tight, and these kind of headlines will just serve to remind us of the geopolitical, the issues at large over here, which will come to the fore for sure next year in particular.
Amrita, there's a consensus behind what you're talking about, that the marginal swing producer of shale isn't perhaps as swingy as it used to be. And yes, that's a CFA term, Tom, just for you. But the idea that perhaps they can't come online as quickly and that the main oil wells have already been drilled. Do you think that people are underestimating the speed at which shale could come back online?
I think this is the million-dollar question for the oil market right now. Saudi Arabia, for one, is definitely betting that U.S. production is not as swingy as you say right now. Look, our view is very similar for this year. 2021, if you look at all the CapEx programs, if you look at all the rig counts and even including our forecast, we simply cannot see how U.S. production is going to rise very quickly this year. However, I will say this year, given these price levels, all the producers will probably for the first time ever, actually post profits, which means for next year, now the larger companies can still be disciplined, but the smaller companies, having reaped profits, can probably reinvest that and grow. So does it mean US production is going to grow at 1 million barrels per day next year? No, probably not. But will it be flat or down like this year? No, probably somewhere in the middle, grow at 500,000 barrels per day. We shouldn't underestimate that.
Amrita-san, thank you so much for joining us with Energy Aspects this morning here on oil. And again, we had a 71 print on Brent. We've eased back to 69.01 with red and green on the equity screen. Lisa, to John's point, as he's mentioned throughout the morning, we're 8, 9, 10 days away from a Fed meeting, and I guess that speaks volumes.
Yeah, and it's not just a Fed meeting. You've got all the major central bankers meeting over the next 2 weeks, and they have this conundrum where basically they expect inflation to pick up in the short term, but don't see it actually changing longer term. They want to remain easy. They want to keep things on track. But there are concerns. Maybe this time is different. Inflation is actually going to pick up more substantially.
And that's the point. You nail it. The idea that this time is different, and we really should mention people that have aggressively pushed back against higher rates, a permanence to it, and also the certitude that we will see entrenched, embedded inflation, a true lifting of the level of prices. David Rosenberg, I think, Lisa, being the most heated.
Well, here's the question, right? It has to come from wages. Otherwise, it's stagflation. Otherwise, it becomes a real problem. So where are we going to get the wage growth? Is productivity going to increase? Are we going to get more innovation? How are we going to get people paid more at a time when the gap is widening? And I think that's what the Fed is trying to address. Congress, too, but Congress is a bit more split on exactly how to do that.
Well, Congress is going to go their own way. And of course, they're going to move on to legislation that both parties feel they need for 2022. But, you know, I go back, Lisa, again, as we heard from Michelle Meyer, their quarter-to-quarter Q4 statistic is 7.3% GDP. This nation's essentially never seen that.
Yeah, I've got a question for you. How's the lumber stash in your apartment? You're building, right?
Yeah.
And building a house to try to cash in a little bit on the record rally for lumber?
Well, the lumber's there. I mean, you know, the commodities are there. You know, we're doing the kennel for the dogs. I mean, we're building that out in the east wing of the house.
Oh, yeah, the east wing.
But we can only do it 5 hours a day because, you know, the nailing and the noise and, you know, the construction noise bothering people. But you see it nationwide. And again, what's the permanence of lumber, the permanence of cotton? You just don't know.
Yeah, and I think about the dollar, too, strengthening. How much does that put a damper on some of this inflation?
What's amazing is we got through this without talking about Meghan and Harry. I mean,
we kind of tried not
maybe
to.
It was because our surveillance royal correspondent left us here in the lurch.
So now he's the royal correspondent.
Could be. Balance of Power today, Elizabeth Cantrell with PIMCO on the new Washington. Stay with us through the day on radio, on television. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies. that we can see the outcome.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
The stock market recovering from New York City for our viewers worldwide. Good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Equity futures turning around positive on the S&P 500, off the lows on the NASDAQ. Let's get straight to it. We begin with the big issue. Good news is bad news for big tech.
The economy is improving significantly. There's a lot of strength behind this economy.
The economy has been outperforming expectations.
Whether it's policy-driven, vaccine-driven, or simply pent-up demand.
Momentum as we enter 2021.
We're ahead of schedule on vaccinations.
Improving growth expectations.
We've had really strong job growth.
Yields are going higher because of expectation for growth.
As the outlook improves,
rates are going to keep rising.
That will ripple through to equities.
The rise in interest rates is not a good thing for the market.
The downdraft we've seen in technology.
I didn't think the markets would react so aggressively to the downside.
Technology names have come under pressure.
It's the rapidity of that increase in yield.
The technology sector has, as you chronicled, has really taken it on the chin.
That's the pain trade right now.
That is the pain trade right now. Let's get to the Bloomberg team. Sarah Ponzek, Katie Lyons. Morning, Sarah.
Good morning, John. And at the center of every story lately really has been the bond market. This morning, 10-year yields flirting with 160 once again. It was on Friday after that better than expected jobs report that we saw 10-year nominal yields move as high as 162. So since February 10th, we have seen a move of about 50 basis points here. The first quarter of 2021, about 70 basis points. That would be the most for any quarter since 2016. This is about better than expected growth, but at the same time in the past 2 weeks, we have also seen inflation expectations starting to pick up once again. 10-year break-even inflation expectations holding at the highest levels now since 2014. Now, on top of the demand side of the equation, a better than expected an economic recovery, at the same time, you have more supply hitting the tape, and the Treasury market is going to have to digest this, especially this week. We have $120 billion worth of Treasury securities on the block that the market will have to supply. It was just about 2 weeks ago that we saw that pretty ugly 7-year auction, the lowest ever bid to cover ratio. And that is what really pushed, for the first time, 10-year nominal yields above 160 in that flash crash like move. At the same time, though, when we think about the read across to the equity market, yes, this is not good for growth. This is not good for tech. However, this is good for cyclical parts of the equity market. For example, banks. And if you actually look at a ratio of S&P 500 banks versus the S&P 500 versus 10-year Treasury yields, they have tracked pretty closely together. Now, banks are up 20% year to date, but when you think about what this means for the benchmarks at large, only making up 4.5% of the S&P 500, that doesn't mean it's really going to help on the way up, John.
Sarah, that's the story. Sarah, thank you. Sarah mentioning the supply later this week. Here are the numbers for you, just briefly. $38 billion of 10-year notes coming Wednesday. On Thursday, $24 billion of 30-year bonds. In the equity market this morning, came into work 5 a.m. Eastern. This market was down and down hard. Equity futures on the NASDAQ off by more than 2%. We recover as we inch towards the open. For more, here's Kaylee.
Well, John, yeah, the NASDAQ 100 futures are only down about 0.3% right now. So we will see if at the cash open in just under half an hour's time, there is some follow-through buying from the rally we saw on Friday. But of course, it has been profit-taking, not dip buying, that has won out in big tech in recent weeks, driving the ratio of the NASDAQ to the S&P 500 off of its highest since the dot-com bubble. It really comes down to the valuation question, John. The NASDAQ 100 trades at a forward PE multiple of about 27. That's off its most recent peak, but still elevated relative to history. And the justification given for that for a long time was ultra-low borrowing costs. As those borrowing costs move higher, that equation starts to change. Plus, you have to layer on the fact that the primary driver behind the higher move in yields has been expectations for growth and a reopening economy. And that could mean the growth for some of these tech companies that they experienced in the stay-at-home world is going to start to slow down. It is these dynamics that have driven shares of the likes of Apple and Amazon lower by about 10% over just the last month. But perhaps no fall from grace has been quite as extreme as for Tesla, down 30% over that time. It has erased $234 billion in market value over just the past 4 weeks. No surprise, given such a steep move between early February and early March. It has also given back all of its gains for the year. Tesla now down 15% so far in 2021 after a gain of nearly 800% in 2020. Apple and Amazon also down around 8% on a year-to-date basis as those momentum trades have unwound in quite dramatic fashion, John.
Kelly, thank you. Worth reiterating it. Those three names, a quarter of the index, just unreal. A quarter of the NASDAQ 100. Keep going back to this. Good news is good news for who? Good news is bad news for who? And it's good news, bad news for this market more broadly. Oksana Aronoff joining us now of JP Morgan Asset Management. So Oksana, let's start there. Just a brief, broad comment from me. Is good news bad news for financial markets?
Good news is bad news for continued support of the financial markets, right? In other words, we have, many investors have staked their relationship with the market on continued support from the central bank. But if there are good news, then the question, of course, arises, how long will the central banks continue to support markets and continue to support current valuations? Good news is certainly not good news for bonds specifically. And I think this prevailing rhetoric that, stronger growth is going to translate to better credit opportunities is definitely not going to be particularly great for credit here, because credit's already marked for perfection, frankly. So it's unclear how it can possibly deliver strong returns, even if this good news around the economy continues.
You've maintained a really high cash position, a liquidity cushion, Oksana, in your portfolio. What are you waiting for? What are you anticipating, if anything?
So we are strong believers in fundamentals-driven investing, and we're strong believers in being compensated for the risk when you are investing capital in the markets. And it is completely not the case at this point that you are compensated for the risk when you are putting money to work in this market, because even when you look at some of the more speculative areas of the market, you're not compensated for the default prospects that we expect to materialize there. And by the way, I also don't think that the default forecast of sub 2% will be on track this year. I think we're going to see more than that as some of these more zombified players start to struggle in a higher interest rate environment.
So Oksana, anticipated default rates that I've been looking at have been trending lower. You clearly think they start to climb again. Can you walk me through, say, the maturity wall, the financing needs that you think are more acute and not appreciated going into year end with high yields?
So it's going to depend on how strong, of course, the recovery will be. But given how low rates are here, it really doesn't take a lot for companies to start struggling in terms of continued refinancing. And remember, some of these more zombified companies, as they've been called, right? Companies where their revenues are really struggling to cover their interest costs, frankly, they have front-loaded their maturities. And so even as you have the belly of the curve move up, the 5-year, the 7-year part of the curve move up, it's really going to be difficult for them to maintain access to financing in these markets. So that's important to remember, because that can have cascading effects in portfolios, and selling begets selling, of course. In terms of actual, yields and which part of the curve can move, we've seen the belly of the curve move up in trying to reflect the stronger growth expectations, which the Fed has been telegraphing they want. So if these markets actually give the Fed what they want, there's really going to be some repricing of interest rate risk, which will cause all risk to reprice, from the lowest rated to the higher rated. And that is something that I think the market's really not taking into account right now.
We've asked it continuously over the last few months just how self-limiting will a treasury market sell-off be if it started to infect risk assets more broadly. Oksana, stick with us. I'm looking forward to the conversation. Oksana Aronoff there on the latest in this market, the Fed. Just a huge amount of debt supply that's come into this market as well over the next couple of weeks too. Let's get you some movers at the market desk. Here's Abby.
Good morning, John. Well, let's start out with the area of the market that's really hurting this morning, dragging, and that, of course, is big tech. Off of the lows, though, at the lows, as you and Kelly had been talking about earlier, the NASDAQ 100 down more than 2%, now down just slightly. The big drags, though, not surprisingly, Apple, Microsoft, Intel. These stocks are mainly technically damaged, suggesting more selling could come in the days, weeks ahead. And, of course, this has to do with that repricing of risk that you were just talking about with Oksana. As yields climb, folks worry about valuation, especially for these big tech names. That's true, too, for the EV space. If we take a look at the Teslas of the world, the NIO, of course, last week put up a rough quarter. Nikola trying to turn positive. Earlier, all of these stocks lower, but too far, too fast has these names, as Kelly earlier was outlining, down sharply over the last 4 weeks and on the year. But again, a little bit of a turnaround. And then finally, let's turn to the healthy part of the market. And this, of course, is the reflation trade. You have your banks higher. You also have energy higher. These, of course, were the two worst sectors last year. This year, John, as you know, they are the best sectors. Catch up on that reflation reopening trade. Hopes that the economy is just simply going to take off this year, John.
Unreal. Keep saying it. Unreal. S&P 500 banks this year to date, we're not even in the middle of March, year to date up 20.21% on the S&P 500. And as Abby, the team, Sarah, Kaylee pointed out repeatedly, it is not enough to advance this benchmark when the weighting to tech is north of a quarter of the overall S&P 500. Abby, thank you. Coming up, the Senate stimulus package heading back to the House for final approval, $1.9 trillion worth. What made it possible? This bond market makes it possible. Will that be the way for the rest of this year? That conversation up next with JP Morgan's Oksana Aronoff, and I'm pleased to say joining us, Crossmark's Victoria Fernandez from New York City this morning. Good morning. Counting you down to the opening bell in New York with 20 minutes to go. Your equity market going from negative to positive. We flip positive by just a couple of points. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women have a very clear objective
They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It obviously wasn't easy. It wasn't always pretty, but it was so desperately needed, urgently needed. Everything in this package is designed to relieve the suffering and to meet the most urgent needs of the nation and put us in a better position to prevail.
The Senate narrowly passing President Biden's COVID relief package, voting along party lines, Democrats moving a step closer to an early legislative win, with Republicans remaining united in their opposition.
When people find out what's in this bill, they're going to lose a lot of any enthusiasm they may have for it right now. This was never about getting people back to work or kids back to school or the disease behind us.
Bloomberg Chief Washington correspondent Kevin Cirilli joining us now for more. Morning, Kev.
Good morning, Jonathan. Let's take a look in terms of the timeline for passage in the House of Representatives. I'm hearing from sources on Capitol Hill this morning that likely the first procedural vote of this process, because of the significant changes in the Senate, will take place New York time this evening in the House of Representatives, which means another passage as early as tomorrow, New York time, for the House of Representatives. Speaker Pelosi is going to have to keep every Democrat in line, including those progressives who are disappointed that the Senate version of this bill does not include minimum wage, nor does it include wider access to those $1,400 stimulus checks. Let's take a look at who would qualify for the stimulus checks eligibility. They would start at $1,400, but individuals earning more than $80,000 won't qualify. That was previously $100,000 in the earlier draft. The ceiling for couples is going to be $160,000 annually, and that is down from $200,000 in the previous draft. So it's more difficult to qualify for these $1,400 stimulus checks. And I can tell you over the weekend, talking to progressives, they don't like that at all.
Do you remember when we used to talk about bipartisan effort, Kevin?
Yeah.
This was anything but. This is Senator Schumer saying the following: unity, unity, unity. That's how we got this done. On every single important vote, every Democrat stuck together. Just wonder how this sets the tone for the rest of the year and the next big effort too, Kevin.
You know, there's a big hearing this week on the Senate Energy Committee chaired by Joe Manchin, the centrist from West Virginia, on grid electability, weatherizing the electric grid, rather, in wake of what happened in Texas. I raise this because the political capital that the Biden administration used on stimulus to get Democrats in line is significant. They used a lot of capital. And so people like Chairman Manchin and Senator Elizabeth Warren, are they more or less inclined to work with this administration on infrastructure, on universal pre-K, on taxes for the wealthy? There's a clear divide. It's going to be fascinating to watch it uncover.
Are we allowed to jump to midterms in 22, Kevin, just yet? Just picture it. We're looking at blowout numbers through this year. Maybe something goes wrong with the pandemic and knocks us off course, but the economists that come on this program are looking for anything close to 6-7% GDP growth in 21. You throw on top an infrastructure plan, could be booming into 22 as well, Kevin. And I just wonder how Republicans want to vote going into elections next year with an economy that could look pretty decent.
Jonathan, there was a moment in your great interview on Friday with Jared Bernstein where you really poignantly asked him about minimum wage, something that Jared has fought for decades. And to lose that battle in the policy arm in this fight is a devastating blow to Democratic progressives. Will Senator Elizabeth Warren's PAC primary individuals? Will Democratic Socialists primary individuals in the midterm elections? No, it's not too early to start talking about it, but yes, we need to start talking about it because that's the story. We talk about it on the right. It's the same exact story happening on the left.
You and I will start talking about it. Kevin, good to see you. Kevin Suri down in Washington, D.C. Let's bring in the panel, shall we? Victoria Fernandez, a crossmark, and JP Morgan's Oksana Aronoff still with us. Victoria, let's start with you. How big is too big and is $1.9 trillion too big?
Well, I think 1.9 trillion was bigger than most people expected. We didn't expect to see that full amount actually come through, even once the Georgia elections went through. We actually expected to see something more around 1.25, and I think that's what the market anticipated. So you see these move higher in rates. You see some volatility going on with the Dow and the S&P. I think the NASDAQ is a different story because of tech, and some of that has to do with the fact that we've got this larger stimulus package that we now know is probably going to be signed this week. And how does that flow through? Because we look at what was passed in December, only about 20% of those stimulus checks were actually spent by consumers. The rest went into savings. So as you sit here and talk to Kevin about what we anticipate later this year or even next year, I think the savings is going to build back up north of 30% where we were a year ago. And the consumer is going to be set to really drive GDP and spending over the next 18 months.
Just how high is this multiplier on this plan down in D.C.? That's a real debate right now. Oksana, the other debate is whether we can take down the additional supply from Treasury. 7-year auction a couple of weeks back was just absolutely ugly. We get 10s and 30s later this week. Are you comfortable, Oksana, with the debt coming to market and being taken down comfortably?
Well, let's not forget, and make no mistake about it, that the biggest source of support for our debt has been the Fed. And without, well, I shouldn't say without, but if the Fed starts to pull back their support because the economy continues to improve, then certainly we will have issues with, where that debt will struggle to find a buyer. Although there's always, of course, the possibility that overseas buyers continue to find our rates more attractive. And I think that's kind of the mantra for those that continue to be invested in the debt. But that 7-year auction was kind of an interesting shot across the bow because, of course, nothing really changed effectively outside of just expectations. And as was mentioned, the size of this relief package was significantly larger, which of course will create more need for debt. And using more debt to get out of a problem is a great thing in the short term. Long-term ramifications, frankly, are anyone's guess because we haven't seen inflation up until now. But as was just mentioned, this is a very different kind of stimulus. This stimulus aims directly for consumer pockets. And as such, it can have pretty significant impact on inflation. And I am by no means an inflation hawk. And let's be really clear about the fact that, hyperinflation, all of these things that are being thrown around, that's really not what I'm pointing to here. But the fact that, again, given that we haven't really seen inflation in so long, any amount of stirring, so to speak, with respect to that measure can have pretty dramatic ramifications. And, you asked earlier, what would get us to move sort of outside of our significant liquidity position? It is getting through a point of vulnerability. What I mean by that is valuations currently are extraordinarily vulnerable to any kind of catalyst, whether that catalyst is a tiny bit of inflation, whether that catalyst is just changes of expectations around the prospects for inflation. By the way, don't underestimate how important that is to investor behavior and therefore prices in the marketplace, whether it is some geopolitical event, whether it's a different default rate that materializes from the one that forecasts. I mean, your guess is as good as mine. I can't tell you what's going to happen in the future, but I do know that valuations here are extraordinarily vulnerable, not unlike 2019, where at the end of that year, we got the same question because we were, again, had a significant allocation to liquidity. And we were always asked, what gives? Why would you guys be here now? And the answer is, we don't know the future, but we know that things are extraordinarily vulnerable now. This is the time to focus on capital preservation.
You're kind. It was me that was asking the question at the end of 2019, Oksana. You're too kind. Victoria, this situation right now is unique. This plan is unique. This moment is unique. This shock has been unique. And what's unique about this moment also is that the bears and the bulls agree on what the data looks like in several months' time. It's good. Inflation's up. Growth's up. Things are booming. That's what most people expect. What they disagree on is how perceptions of policy will adapt and how markets will respond to. On that better data, Victoria, what do you anticipate the middle of the year looks like? That's the debate right now.
Yeah, and I have to say, I think we're going to see the markets continue to trend higher because of this better data that we're seeing. There is concern in regards to the Fed and how they're going to react to some of the data, how they're going to react to higher rates that are inflation bets going on. And is the market starting to pull in sooner? Because we've seen that 5- and 7-year part of the curve start to move higher. Are they pulling in the expectations of when the Fed is going to move? Do we get tighter financial conditions? You were showing that chart earlier this morning. Is that going to force the markets to make a shift? I don't think so. I think the fact that we're going to continue to have low rates on the short end. You look at the housing market. It's not derailing because rates are moving higher, and that's the most direct pass-through from policy to households. Households have strong balance sheets right now. Their consumers are getting more money in their pockets. We're reopening. Expectations are 7% right now on GDP growth. I'm here in Texas, so we're doing 100% reopening at this point in time. I think you're going to start to see all of these factors feed through. We're probably going to get another infrastructure bill coming as well. That's going to let the markets have some solid foundation, and we're not seeing concern in the credit markets right now, Jonathan. They're still holding steady, and for us, and the fact that there's not a flight to quality into treasuries right now tells us that yes, there's some consolidations in the NASDAQ and in those tech names, but the rest of the market seems pretty solid and is going to be a good foundation for the rest of the year.
Ladies, really sharp conversation, and appreciate your time this morning. Victoria Fernandez there and Oksana Aronoff of JP Morgan Asset Management. Up next, the analyst action you need to know. That'll be next in our morning calls, and then later, rising bond yields turning market darlings into laggards, and why we have seen a huge boom in small caps with Jill Carey-Hall and Emily Rowland from New York. This is Bloomberg.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Equities recovering going into the opening bell. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Pivotal Research upgrading VF Corp to a buy. The analyst forecasting a favorable backdrop with a number of brands facing easy comparisons. Your second call from RBC upgrading Coca-Cola to outperform. The analyst expecting the company to benefit from improving consumer mobility. And your third call from Citi downgrading SeaWorld to neutral. The analyst seeing little upside remaining at current levels. That stock is negative 0.7%. Coming up, surging bond yields dictating equity markets, keeping former tech darlings under pressure. Small caps surging. That conversation up next with Emily Rowland and Jill Carey-Hall from New York. Your cash opens next. This is Bloomberg.
Okay, guys, if you're up to Bitcoin, there's your chance. If you like Bitcoin, we're looking to buy Bitcoin, and the price we're looking to buy 51,895.81. Okay, here is the 51,000. 8,951. Okay, so we're placed an order to buy Bitcoin at 51,829 pounds. You still have a chance to buy at this price. So if you're looking to buy, let me know. Like, okay. So if the price will move lower, we will buy. So if you're looking to get filled, you still have a chance, you still have time, so you can follow this trade, and then I will let you know what's happened, what's going to happen, and when we're going to sell. Please don't forget that we calculate Bitcoin profit based on a percentage, not based on pips. So in this case, we will calculate 0.1%, 0.2%, and so on. Okay? I'll speak to you later, guys.
And or 118.73, and EM getting knocked around as well. The peso, the rand, and the Turkish lira. In a commodity market, we saw 70 on Brent earlier. You see 65 on WTI now, just south of 66 and down around about 0.5%. That's the cross-asset setup this Monday morning at the market desk with your movers. Here's Abby.
John, as you were just mentioning, what a turnaround for stocks since the pre-market lows. At the lows, that NASDAQ 100 down more than 2%. Right now, down just slightly. The S&P 500 higher. Let's take a look at what's not working and then what is working. What's not working, the drags, of course, big tech, but well off the lows. Even so, this has been the pain trade recently. You have the tech index overall basically close to a correction below its 50-day moving average, flirting with the 100-day moving average, telling you that the sellers are really moving in. So we're still seeing that today as rates are moving higher. Questions around valuation too far, too fast. As for what's working, it's all about the reflation trade, a stock-specific story. Apollo Global and Athene. There, of course, is a deal in the works potentially. Here is actually in the works. Apollo Global is acquiring Athene for $11 billion. This, of course, combines the private equity firm with the insurance company, high demand products, and Apollo was already Athene's largest shareholder. As for the true banks, the big banks, lots of green here happening with rising yields. Bank of America, Citi, Goldman, all higher on the reflation trade. And one reason there, of course, is this debate between reflation and inflation.
Position opened on Bitcoin. So these days, some people really like Bitcoin. So yep, here is the chance. We bought Bitcoin at 50,829. So let's see, let's wait what's going to happen. And when we're going to sell, it will take a while, a couple of hours, or maybe we'll hold it until for a while until we will get profit from it. Okay? If you want to get a strategy, if you want to find out how we trade, why we purchased at this price, why we trade at this price, how we trade, the strategy available on our website, and you can get it once a week. I personally provide the webinar workshop on Wednesday, so you're welcome to join for our workshop and find out how we trade. We trade for years, for over 20 years. Soon, probably in about 4 or 5 years, we're going to celebrate 30 years of trading and using this strategy. So you're welcome to get the strategy and use it with other pairs, because as you can see, we show you on the screen only 5 pairs. You can say 4 pairs and Bitcoin. So if you will get the strategy, you can use other pairs, you can use stocks. It will work on other tradable securities. Okay, guys, well done. You purchased Bitcoin, and I'll speak to you later. I'll speak to you when I will have any news or another chance opportunity to buy or sell, enter position on pairs you see on our screen. Okay?
Two of the 3 biggest sector laggards have been technology-oriented. Consumer discretionary, which houses Tesla and Amazon, down about 9%, information technology down by 5%. That is the bulk of the weight within the index. So the drag there is offsetting a big chunk of the gains we've seen in value plays like energy and financials that carry less weight. That is why the market-weighted benchmark is down about, or only up about 2.3% on a year-to-date basis, while the equal weight index, in which Apple pulls no more weight than any other stock, is up by about 7.5%. But outperforming both of those large cap indices is the small caps, John. The Russell 2000 index up more than 11% so far this year, a big beneficiary of the reflation trade, John.
Up more than 40%, I think, since the end of October. Kelly Lyons, thank you very much. On this International Women's Day, I wanted to highlight 2 of the most important calls on Wall Street over the last several months. One was from Jill Carey-Hall of Bank of America to stick with the small caps, and the other was to stick with the US cyclical story. That was from Emily Rowland, who joins us from John Hancock as well. And Jill, let's start with this call on small caps. You got ahead of it. We've seen a massive move. Why do we stick with it?
Thanks. Yeah, I mean, small caps have had a great run, but we don't necessarily think it's over. And when you think about our broader market call this year, we've been more neutral on the S&P 500 large cap index due to some of the themes you mentioned. You know, big cap tech is certainly a big driver, and as we see that transition from growth to value, that's not necessarily a bullish theme for the S&P 500. And a lot of last year's gains for large cap stocks were kind of pricing in the earnings growth we're now expecting to come through this year. But we think it'll be a better year for the U.S. economy than for large cap stocks. And that's where you really see small caps as the beneficiaries. They're more similar to the makeup of U.S. GDP growth. They're more services oriented, where we see still a lot of room for pent up, spending demand to come through there. And the inflows we've seen into small caps are still, not in the magnitude of the outflows that we've seen for years now. So we actually think we're set up for what could be a good multi-year run for small cap stocks.
Emily, just to build on this call, linked to it has really been your reluctance to invest internationally, to stay at home, to stay glued to this US cyclical story. Why is that going to be the case as the year progresses?
Yeah, so John, we've continued to lean into the U.S. as far as playing cyclicality. And if we look at economic growth prospects globally, the U.S. is clearly emerging as far as an accelerating economic growth backdrop. We're seeing the steepening of the yield curve play out, unprecedented fiscal stimulus in the pipeline, earnings blowing out expectations. All of these things have been really supportive of this rotation into cyclicality. So we're playing that through an overweight to areas like U.S. mid-cap equities. We're looking at it through the lens of industrials in the U.S. that we think should be a huge beneficiary from this increased level of fiscal stimulus here. So adding to that part of a portfolio, I think, is important. It doesn't mean that we want to fully, sort of give up on the quality story and the growth story. We talked about this unprecedented stimulus. It's probably never going to be this good again in our lifetime. So we need to think about having an allocation there, not fighting it, but also recognizing that stimulus may fade as we head into the back half of 2021.
I found the last 12 months really humbling. And Jill, one of the struggles that I've had is just how quickly things have moved. And when Emily talks about things changing again at the back end of the year, I really struggle to keep up on where on earth we are in this cycle right now. Jill, where are we?
Yeah, it's a great question. We've tried to track different macroeconomic inputs to put them together into an indicator to figure out where we are in the cycle. And what that indicator is telling us is that, we just moved from the big, early cycle recovery bounce off the bottom to more of a mid-cycle environment where the recovery is still occurring, but at a slower pace. And, we found pretty consistent performance based on different styles, depending on, what regime of the cycle that you're in. And, in this mid-cycle phase, you do see some consistent patterns relative to what you saw early cycle, where small cap stocks, value stocks should continue to lead. And even though we wouldn't expect, the same magnitude of gains for small caps that we saw over the last year, we found that if we are in a new, multi-year regime for small caps, that the second year where small caps outperform, they can still see on average, 10, 12 percentage points of outperformance versus large caps, sometimes more. So I think if we see a CapEx cycle in the US, that's another bullish theme for smaller stocks, whether it be from, infrastructure spending, whether it be from reshoring of US manufacturing. And so the here on International Women's Day, another bullish theme for small caps just could be more disclosure on, ESG related policies, because we saw large cap stocks re-rate on that aspect as well.
One thing you've done with Savita, Jill, is have a call of 3,800, and idiots like me pushed back earlier this year when growth was absolutely flying and basically asked, when are you changing the price target? And now we are at 3,800 and struggling to really get a lift because of the consolidation we've seen in growth. Now, I understand the call over the next several years is relative outperformance on small caps. Jill, can you help me understand absolute performance of growth in the next couple of years and when you start to see things kick back in?
Right. I mean, I think, we've seen a lot of these, mega cap, big tech growth stocks dominate the market and dominate the market cap of the S&P 500. In recent years, the outperformance of growth has been extremely strong. So I think right now, if you're in a backdrop where we're seeing that recovery slowing down to mid-cycle, that's a backdrop where you want to be in value stocks. Now, obviously, as the recovery slows, those environments tend to be more beneficial for growth stocks. But I think there are a number of challenges and headwinds we see to growth outside of just, where valuations are, where positioning is. So I think from a growth versus value perspective, obviously there could be regulatory headwinds. Tech is one of the more unregulated sectors. A number of factors that we're watching that could impact growth stocks on a relative basis. Within small caps, growth tends to be a bit more of a consistent factor over time. So not necessarily saying you want to be out of growth within small caps in particular, but we're still in a phase right now where value could do better. And I think you're still not seeing, even despite the gains we've seen in small caps, you're not seeing value and cyclicals really reflect that yet. You're still seeing small cap cyclical sectors trade at these, extreme relative discounts to other areas of the market. So I think for the time being, that's where you want to tilt.
Jill, a wonderful call over the last several months. And when we look back on Wall Street, there is this terrible inclination to say the easy money has been made. There's nothing easy about making the call when you have to make the call. It's super easy to look back when the call looks good. Jill Kerry, you made the call. Jill Kerry Hall there, making a call on small caps to outperform. And Emily Rowland of John Hancock will be sticking with us on the dollar story, international commodities and EM coming up very shortly. Looking forward to that. I want to get back to the market desk with your equity market up a third of 1% on the S&P 500. The NASDAQ just slightly negative. Here's Abby with more.
John, let's start out with the sectors and the names that are really working. And industrials, that's a top sector this morning, a piece of that reopening reflation trade and a big point boost there. GE up 3.3%. We also have AerCap up soaring, up 12.6% on the news that GE is likely to, that there is likely to be a deal between these two companies to create a giant aircraft lessor. The deal could be announced today and it would be worth more than $30 billion. We also have more of a reopening flavor if we go toward travel. And this is also another piece of the industrials, though. Disney up 3.6% on the news that parks and sports arenas will be allowed to open in California April 1st with some capacity limits. But take a look at Norwegian Cruise Lines, another piece of the travel trade, and then the airlines. That, of course, is why the industrials are up so much as well, just soaring on the expectation that this economy is on the cusp of reopening. As for where we have some pain, though, some downside, that, of course, is big tech. Take a look at Apple, along with some of the Apple suppliers. Those chips names down sharply. Apple, John, very close to its 200-day moving average. If it tests that, it'll be the first time since last March when we had that brief bear market.
The last 30 days, it's been rough for Apple, Amazon and Tesla too. Abby, thank you. Coming up, Brent crude had a little look at $70 a barrel earlier on as Saudi Arabia reportedly faces another attack. That conversation up next with John Hancock's Emily Rowland from New York City this morning. Good morning. Equity futures were deeply negative on the NASDAQ earlier in the session. The NASDAQ now positive a tenth of 1%. The S&P up 0.4 of 1%. From New York City this morning, good morning. This is Bloomberg.
there's a lot of optimism around demand, but unless and until we see that in the numbers, we are actually not going to bring production back. We're not going to preempt anything. And I think that's why, while I don't think prices are going to go up very sharply because of the spare capacity, the market is still very tight.
And Rita Sen of Energy Aspects on the oil market. Crude very briefly this morning on Brent with a 70 handle. For more, let's bring in Bloomberg's Sarah Ponzek. Hey, Sarah.
Hey, John. Now, last week, supply has been the story. Over the weekend, a series of missile and drone attacks in the Middle East by Houthi rebels. Saudi Arabia, though, saying that oil output appears to be unaffected. Still, though, we did see Brent oil, as you mentioned, shoot above $70 a barrel for the first time since early 2020. WTI nearing $68 a barrel. Still, though, yes, many of those gains have been paired, but still trading at the highest level since April of 2019. It's just another tailwind after that surprise outcome from the OPEC meetings last week, and as we see more demand coming online. But it's not just energy. Commodities have been on a tear in 2021. If you look at the different subcomponents of the Bloomberg Commodity Index, for example, yes, energy up the most a few months into 2021, up 26%, but agriculture, industrial metals, also in the green, solidly in the green. Now, the flip side of that, though, is your precious metals, silver, gold. Gold prices, for example, down 18% since August. Back then, that's when gold was trading above $2,000 an ounce. We're far below that now. At the same time, investors have very much taken notice. If you look at gold ETFs, assets within them, we have seen 15 straight days of outflows for gold ETFs. GLD, which is one of the most popular gold ETFs, lost close to $6 billion already this quarter. That's on track for the worst quarter, John, since all the way back in 2013.
Sarah Ponce, thank you. Underpinning many of those stories in the commodity market will be your view on the US dollar, where you think this US dollar is going to go. I want to briefly bring you some news on the bond market. It's very hard to reconcile the commentary from the ECB and the bond buying, the rate of bond buying they've been doing. This is the latest. The ECB kept the net pandemic bond buying pace little changed last week. So ECB decision on Thursday, news conference with President Lagarde. I refer back to that speech from Fabio Panetta, or the recent comments from Fabio Panetta of the ECB recently, saying that basically we've seen an undue tightening of financial conditions and it can't be tolerated if it's led by better growth in the United States and higher treasury yields, if we're not going to see that higher growth also in Europe too. So a really interesting conversation coming up on Thursday. Full coverage right here on Bloomberg. I want to reiterate the outlook of John Hancock's Emily Rowland, expected a new investment regime in the wake of accelerating growth. She writes the following: a vaccine breakthrough, unprecedented fiscal stimulus and earnings expectations blowing out, a trifecta that's likely never been seen before and may never be seen again. But here's the kicker. This is the punchline. Don't get too comfortable with this type of backdrop lasting too long. Emily is back with us for more. Emily, let's start there. Don't get too comfortable with this lasting too long. When does it start to fade?
Well, for right now, we want to, again, have exposure to cyclical parts of the market to benefit from all of this. And it could last for a couple of quarters here. One thing that we look at is the Treasury yield curve, and the difference between the 2 and 10-year Treasury right now sits around 140 basis points. Clearly, we've seen some pretty rapid steepening here happen. But if you look over the last 10 years or so of the cycle, typically you see that spread get to upwards of 200 or 300 basis points. So we still could have a ways to go here in terms of the yield curve steepening and that concomitant outperformance that you see from more cyclical or economically sensitive areas of the market. Once we start to see, and we're looking for the signal from the bond market to sort of tell us, you know, here's the peak of economic growth that's being priced in. And then once we start to see the yield curve start to flatten a bit, that's when you might want to lean more into those longer duration assets like technology. But for now, we want to continue to play value, small caps, et cetera.
How does the dollar behave in line with those expectations, Emily?
Yeah, so we look at the dollar through a number of lenses, and one is just by looking at relative economic growth. And I think that as you see PMIs here in the U.S. reflect better economic growth prospects than they are internationally, that creates a bid for the dollar. But the other thing to remember is that the dollar is a risk-off currency. So investors are starting to reevaluate the amount of risk that they're taking in portfolios now. Equity markets are taking a little bit of a breather here. And we think that does have implications for the U.S. dollar. Areas like emerging markets currencies are really getting hurt right now as investors sort of reassess that risk level. So the dollar is getting a bid here, and we think that that's something that could persist. As you know, we've been hesitant to fully embrace that weaker dollar narrative. And of course, there are key cross asset class implications here. Emerging market equities, for example, is one area that we've started to see some pain in as the dollar has continued to strengthen here. So a lot of it has to do with the Fed. A lot of it has to do with this relative economic growth backdrop. But for now, I think the U.S. dollar remains fairly well bid.
Emily, your time is valuable. Thanks for giving some of it to us today. We appreciate it. Emily Rowland there of John Hancock. This market, I'm struggling to keep up. The S&P 500 up 1/4%. The Nasdaq now negative again, down a little more than 1/10%. Call it almost 0.2%. On a sector price action, here's Abby.
John, this market is a little wild this morning because not so long ago we would have called it clearly risk off. Right now it's looking risk on. If we go into the Bloomberg and use the IMAP, we will see most sectors for the S&P 500 are trading higher. Investors clearly want in on stocks. Now, really interesting, up top, consumer discretionary up 1.2%, higher now on Amazon's and Tesla. Some of those stocks really flying. Only a couple stocks down in that entire sector, so that's a real turnaround. And then you have the cyclical sectors, financials, materials, industrials, very healthy. On bottom, though, tech down 0.7%. That's the story of the year. And on the year, John, let's take another look at a year-to-date board because it is extraordinary. Take a look at that energy sector right now, up 39%, headed to its best year ever on record since 1990. It's only the beginning of March. The financials up 15%. That is that reflation trade in spades. And as you have pointed out many times, last year's worst sectors catching up this year in a huge way. To the downside, though, and this has everything to do with falling yields, you have consumer discretionary, which is actually now down more than technology, interestingly. But those are your big internet names, then your tech names. Investors want out of those high growth momentum names after flying high last year. And of course, as yields are rising, changing the valuation picture. But big numbers there for energy and financials, John. Really
Energy up
extraordinary.
almost 40%. Unreal. Abby, thank you. And great work today. Abigail Doolittle there on the latest in this market. Coming up on the program, the market moving events you need to be watching. That'll be next in our trading diary. And the markets right now, almost 23 minutes into the session, whipping between gains and losses on the Nasdaq all over the place, but well off the lows of this morning. Early this morning, down more than 2% on the Nasdaq 100 on futures. We recover as we inch towards the opening bell. In the early part of the session, the S&P up 6 points. We advanced 0.2%. The story of the last several weeks, very much in the bond market. A bit of stability after blasting through 162 in Friday's session. We had a little look through 160 earlier, 158.89 on 10s at the moment, up 2 basis points. From New York City this morning, back to work. Big week ahead. This is Bloomberg.
We're in the beginning of 2021. What are your biggest worries?
The inequality of the current world environment. It's troubling, and I think it's actually getting worse, which is a big challenge.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
25 minutes in, here's the stock market. The scores look like this, up 0.4% on the S&P, outperformance on the Russell, underperformance on the Nasdaq. You've seen that story before. You've heard it a million times over the last several months. You can see it again, that the Nasdaq has been really volatile throughout much of this morning. Looking ahead to your trading diary, the rest of the week looking like this. US wholesale inventories coming up at the top of the hour. Alex Steele, Guy Johnson will run you through all of that. US CPI and PPI coming up on Wednesday and Friday, respectively. And then it's the big one for me, a central bank decision and news conference with President Lagarde on Thursday. And I think this is going to be fascinating. I cannot reconcile the commentary with the rate of bond buying. If you're unhappy with what's happening in the bond market, big question,